Good morning and a very warm welcome to our virtual Bell Investival 2021. Following our in-person event last week, I can tell you firsthand how good the day was with a full house. It was great to see so many advisors join us and support our event. That said, there were still plenty of you that were unable to be there. And given the success of our virtual Investival last year, we didn't want you to miss out. So here we are with the talks that our speakers delivered on the Shaw Theatre stage. Today, you'll hear from some of the finest fund managers around, all covering a variety of topics in their specialised area. Each will present for 15 minutes, meaning that this webinar will run for around 2 hours and 45 minutes. We'll provide a 5-minute comfort break just for you, and we'll of course provide you with structured CPD time post-event. I want to thank you for joining us today. We know how busy you are with clients and other event invitations, so thank you for choosing us. It really is appreciated. We have plenty to get through, but if you've got any questions for our speakers, please use the chat function and our team will get back to you after the webinar. Without any further delay, let's get into our first session. Our first speaker is now head of boys cricket at St Peter's Cricket Club in Brighton, where he helps coach under-13s. He oversees 11 teams from under-9s through to under-16s, and the under-13s can now play adult cricket, and his lad will be an under-13 in 2022, so Alan Russ-Mould is being threatened with having to get his pads on for the first time in 30 years. Good luck with that, Russ. He is also a huge fan of Prince and saw him live 7 times in the UK. He's now busily recollecting all of his albums on vinyl, which is becoming quite an expensive hobby. Ladies and gentlemen, here to set the scene for the day with a markets update, AJ Bell's Investment Director, Russ Mould.
Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this short, slightly 80s themed presentation, I'm going to take you through what I think are the key issues for financial markets now and going forwards. We're all involved in the risk business, not just looking to maximise returns, but also protect the downside. And that's why in this presentation I'm focusing on what could make financial markets lose their mojo, what could spring out of nowhere like a highwayman and say, stand and deliver. Now, in the end, this is important because we've just seen the S&P 500 rack up its best run of consecutive new all-time highs since 1997. And that made me think, I wonder what happened then. And lo and behold, no sooner had the S&P 500 racked up that run some 20 odd years ago than it walked straight into the Asian devaluations in Korea, Indonesia, the Philippines and Thailand. And that debt crisis spawned another bigger one just 12 months later when Russia defaulted on its debts and drove John Merriweather's LTCM hedge fund to the wall. And that seriously destabilised markets. There was a mini bear market in the space of a few weeks. And, stop me if you've heard this one before, the Federal Reserve then rode in like the cavalry with a $3.6 billion bailout of said hedge fund. That, by the way, felt like a lot of money at the time. But it just goes to show that, in many ways with financial markets, they're at the most dangerous when making money looks easiest. And you can argue that is pretty much where we are right now, with equities at all-time highs, bonds not too far away from them even after the recent sell-off, and many commodities up there as well, and house prices barrelling higher absolutely relentlessly. So you pretty much look across the board, making money looks easy, and that is again when things can be difficult. So we all know the phrase, markets like to climb a wall of worry. The obverse of that, which people don't tend to remember, is they then slide down the slope of hope. And doing my job as I do for AJ Bell, dealing with press inquiries, helping broadcasters with their research, journalists with their stories, and customers and clients as well. What are the things that I've been getting that people are worried about right now? What are the issues that they're raising? Well, they range, understandably, from COVID-19 to the American debt ceiling, to Chinese crackdowns and an economic slowdown there, and the issue of whether central banks tighten monetary policy, though we all know it's been something like waiting for a planet to coalesce from dust for those first interest rate rises. And then supply chain disruption, energy prices, food inflation, wage increases. Is the inflation genie out of the bottle after 40 years? Those are the questions I do get. The one I never get asked about always to my surprise, is valuation. Because the price we pay, the valuation we pay to access an asset or a security's stream of cash flows is the ultimate arbiter of investment return. So looking at those 8, 9 topics, how would I personally categorize them? You may have a different opinion. But I think at the moment, as far as the financial markets are concerned, for the next 4 topics in 1980 style, the theme is pretty much, Frankie says, relax. They're either priced in, factored in, potentially over-exaggerated, or seemingly under control. Now, for the first one here, I stress seemingly. I certainly don't want to tempt Providence after the last 21 months that we've all had, but I think financial markets' opinion right now is, touch wood, we're through the worst. Now, Mr. Van Tam and Mr. Whitty, they're keeping us on our toes, and quite right too. But from the narrow perspective of financial markets, and I stress just from that perspective, not the wider public health perspective, it's almost as if the worse the news got, the more financial markets liked it, because the worse the news was now, the better things were going to be in the future. And that's often the way financial markets work. And taking a market like India, for example, that's definitely how it worked. The worse the news got, the more the Indian market went up, because the more powerful the government response was to deal with it. And then we got Pfizer Monday, November 2020, and that has made a huge difference. And I think going forwards, we will get more efficient vaccines, pills, antiviral treatments that will hopefully help keep the pandemic at bay. It may well now just become a part of natural life. I'm sat here today recording this at a conference for 500-600 people, so there is a sense, touch wood, that life is beginning to go on again and return to normal. This isn't to minimise the pain that it's caused or the fact that markets could be blown off stream if there was to be a new variant. And I think that would be an unwanted and major development. But knowing what we know today, I think financial markets feel that the pandemic is something they're aware of, they've priced in, and there are ways and means that health care and treatments are dealing with it. So hopefully we can put that one to one side. Another thing that I think we can probably put to one side is the Washington debt ceiling drama. Janet Yellen, Treasury Secretary, said she thinks America could run out of money by the 15th of December. That's fine, but the debt ceiling has been raised over 80 times since it was first instituted in 1939. Do we really believe it won't be raised again? No. Now, how we go about paying for that is a separate question, given that the American government has spent $14 trillion in fiscal stimulus since the pandemic started. That's $1.2 billion an hour if you're really into your statistics. And the Federal Reserve has basically monetized that by printing money, then issuing and buying the bonds to fund that. Now, we might not like that, particularly if you're from the Austrian school, but in terms of the debt ceiling moving and being a threat, I personally just don't see it, and I don't think financial markets do either. There'd be a lot more hot under the collar if they were concerned. China's a bit more serious. It's the world's second biggest economy, and there has been a clear crackdown there on profiteering in areas such as education, healthcare, real estate, and dwellings. And also there's been a crackdown on data use, internet use, and all in the name of the common good and the common prosperity. And in the end, we're dealing with a regime that has its own agenda, which is survival, maintenance of its mandate to rule, and if there's collateral damage in financial markets, then so be it. They're also wrestling with the same issue that we are in the West. Interest rates has been low, policy has been loose, speculation has been rampant, asset prices have gone up, particularly property. They're looking to manage that to make sure there's no misallocation of capital on a major basis and there isn't economic fallout from that. And it's not an easy thing to manage, as I suspect Western central banks are finding out too. But ultimately, again, it's possible to argue right now that Chinese monetary policy is actually too tight. And therefore, if given a choice between a serious economic and stock market fallout and loss of faith amongst the population, I think the Communist Party will do what any politician does and take the soft path, which is loosen policy pretty quickly and keep the plate spinning and the show on the road, to mix my metaphors slightly. So again, I think the possibility here is actually China starts to loosen, and then, maybe then, and this is a topic we'll come back to, they start to export growth and export inflation to an already fairly hot running economy globally. So again, this is an issue of which we need to be aware. I think it's one that markets feel have got a handle on, and I don't think necessarily the Chinese will actually let things go too badly wrong. Monetary policy. We've been waiting a long time. The Fed has finally begun to taper. Then we're getting some mixed messages from the Bank of England, which appears to be crawling towards a tightening monetary policy. The European Central Bank is still saying no tightening through 2022. And the Bank of Japan has actually tapered its quantitative easing program. It's not adding to it anymore. But the direction of travel here is clear. 70 odd rate rises globally this year, only about 8 or 9 cuts. So policy, I think we've probably kind of hit bottom for this cycle. The question is, how far do we go? My guess is probably not terribly far because of global indebtedness. And I think that central banks will leave rates low so that rates will run negative in real terms. Under those circumstances, it's pretty tough why even modest rate rises would cause a major market accident. There may be more volatility, but rate rises will be gradual. They should, in theory, be well communicated. Bank of England's last efforts perhaps accepted. And although it's something we have to be very aware of, weight stops horses, weight stops trains, rate rises eventually stop markets, they'll have to go a fair way in real terms, not just nominal terms, before the weight starts to tell. And that, I think, will be some time away yet. What do I think of those early topics as serious issues that could, ashes to ashes and all of that? Well, I think the first one is supply chains. It is a genuine topic. I know that central banks have been saying, move along, this inflation is nothing to see, nothing to do with us. It's down to global forces such as oil, gas, global supply chains, container shipping shortages, silicon chip shortages. But let me spin that around. Global semiconductor sales are going to come out at an all-time high, according to the industry body, SIA, at about $541 billion US. A record high. There are plenty of silicon chips being made. It's just the fact that demand for gadgets, cars and everything else is outstripping them. US retail sales are higher than they were before the pandemic. Household savings, or those who were lucky enough to have a house and assets, they're through the roof as a percentage of GDP. People who've kept their jobs have generally buzzed along quite happily. There's a big wealth effect there right now. Demand, you could argue, is the issue because it is running so hot. If people keep telling us that consumer sentiment is depressed, why are second-hand car prices up 30%? So demand could just be the issue. Maybe, for the best of possible intentions, central banks have overstimulated the economy. Ultra-loose monetary policy meets ultra-loose fiscal policy. We have bounced back out of the recession and the pandemic really so far pretty quickly. Maybe, just maybe, they've overdone it, albeit for the best of possible reasons, and supply chains aren't the problem. And if that's the case, then the inflation narrative really could begin to pick up steam. And food prices are a huge issue. Now, I say this is a history graduate. This is broadening the discussion out beyond the narrow prism of financial markets. But I can pretty much tell you for free, any major degree of populist unrest, urban unrest, revolutions, yes, there are always deep-seated reasons for that. Lack of freedoms, terrorism, torture, suppression of the people. But it's food prices that are things that light the blue touch paper. Whether it's France in 1789, Tiananmen Square in the 1990s, or the African spring of 2011, food was the tipping point. And right now, the United Nations FAO index is through the roof. This is a major problem in emerging markets in particular. It's why rate rises have gone up there very quickly. Russia, Mexico, Brazil have responded very, very fast to try and nip inflation in the bud, and this needs to be watched extremely carefully. And also, where food prices go, inflation more broadly generally follows. So this is an issue that we definitely have to track, and track very carefully. It could cause upset. As could energy prices. Now, this is very difficult. We've had COP26. We know where we are. We know where we want to, and we know where we need to get to. The question is, how? And from a narrow perspective of financial markets, it's going to cost a lot of money. And at this moment in time, demand is going up for hydrocarbons when supply is being restrained by fund managers and pension institutions being reluctant to be seen to be funding these things because we know it's long run, it's where we don't want to be. Insurers refusing to insure new projects. Oil executives under pressure from shareholders to give the money back through dividends and buybacks rather than invest in new projects. So at the moment, we're in an interesting situation. Now, this could change quickly. If America mends its fences with Iran and Venezuela and new supply comes onto the market, oil and gas could come off very quickly. But Russia relations are still tense. Relations are still tense with Iran and Venezuela. Geopolitics has a huge role to play here, and it's unpredictable, and unpredictable things can upset markets. And again, this matter of transition, this issue of transition, that's why I'm reading in more and more blogs the word greenflation. because there is a cost to where we want to go. The question is, how easy is it to fund? The answer might not be very. We've already seen SSE, the FTSE 100 utility, talk about rising capital investment, potentially a dividend cut from 2024, rebasing the dividend from 2024. So there is a cost. Will that become embedded in inflation is a key question. For all the good that we know it's going to do long run, could there be a short run cost? That could create some volatility and some expected developments. And then the final leg of inflation, if you look at a classic inflationary cycle, raw material costs, check. Rising producer prices, check. Rising consumer prices as companies pass on the cost to defend their margins, check. The last leg of the cycle is wage increases, because that's when consumers get the money they need to meet their extra costs, feel accustomed and able to meet those bills, and then the whole thing goes around again. And this is why wage costs are so interesting right now. You're seeing 4, 5, 6% inflation in the UK, the US. It's incredibly important. If this does start to really take hold, that's when inflation could become embedded and the central bank transitory narrative comes seriously unstuck. So it's a key thing to watch going forwards. It's a good thing for many workers. My wife works for a business that's a fashion and lifestyle company. Their distribution centre, they're struggling to find staff because Amazon and Pets at Home are paying people £16 to £18 an hour. And that's great for those people. It's a hard job. They're getting the pay that they need and deserve, but it's driving up wage bills everywhere else in similar areas. And again, that can then start to perpetuate the inflationary cycle as it did, for example, in the 70s. Now, the one thing that people never ask me about, and the one thing they really always need to know, is valuation. Now, valuation is not a timing tool. I remember trying to argue that as an analyst at a sell-side brokerage, UBS, in 1999 with tech stocks. I was right eventually, but the Nasdaq went up 50% first. So valuation is never the catalyst, it's the post hoc rationalization for what went wrong. Now, if you look at this rather complicated chart here, it's based on the cyclically adjusted price-earnings ratio devised by Professor Robert Shiller. And it is currently standing pretty much at an all-time high. Now, the 2 occasions previously when the Shiller PE has crossed 30, the 4 occasions previously when US equities have provided a 10% compound annual return over a decade, the next decade's returns have been pretty skinny at best, if not downright negative. So we need to be careful on a 10-year view. Doesn't mean that we can't continue to party like it's 1999 right now, but it does mean that there may be a price to pay in the future in terms of lower returns. The higher the price you pay, then the lower potentially your returns. So we just need to tread carefully. And again, the question is, what could come out of the clouds and make people think, actually, I have overpriced these cash flows and assets right now? And again, if I was forced to guess of the 8 or 9 topics we've discussed, energy prices is going to be a huge swing factor, wage costs and labour another, with then central bank policy in the background. Again, they have intentionally created a wealth effect to try and support the economy and keep the plate spinning since 2007-9's crisis. They've actually succeeded. But a lot of the recovery is built on fairly soft foundations, debt, and potentially ephemeral ones, wealth based on equities and houses and assets. Now, they therefore suspect they will do everything they can to support those prices, just as they've done with bonds this time. The Fed even bought corporate bonds in small doses in 2020. I wouldn't be in the least bit shocked if next crisis around or next recession around, the Fed was to buy equity ETFs just like the Japanese did. Anything's possible. I don't think they'll give up without a fight, but I do think we will see potentially greater volatility if we see a big sea change from the last 10 years. The last 10 years have been low growth, low rates, low inflation. If we get a change there and move to a less predictable environment of perhaps higher cyclical growth but higher inflation, more unpredictable monetary policy, things may change. Do note here that yes, I can see where the central banks are coming from, that inflation may ease next year. It's a matter of mathematics, a base effect. But in the 70s, we had 4 waves of inflation. The good news is 2 of those were down to the Yom Kippur War of 1973 and the Iranian Revolution of 1979, both of which prompted oil price shocks. Thankfully, we haven't got anything like that on the horizon yet, but it doesn't take a massive leap of imagination to think of something that could be similar. So again, that could be the exogenous shock that pops out of the clouds and causes a big shock of some kind or other. But we can't invest on the basis of something happening geopolitically. It's just too impossible to forecast. But what we can be prepared for is the potential change in mood music that may come. We don't know what's coming. Inflation, deflation, stagflation. I'd be kind of inclined to bet against deflation just because so much money's been thrown out there. Can you think of anything that goes up in supply like money just has, as we've seen here on the central bank chart, and go up in value? No. Supply up, value down, normally, even with money, and we need to be aware of that. So if inflation does take a kick and get involved, we may see a change. We know that markets right now are implicitly pricing in more of the same of the last 10 years. Low growth, low rates, low inflation. Why? Because paper assets have just outperformed real ones, equities over commodities hands down for a decade. And we know because value has outperformed growth hands down for a decade. So I'm not saying that if we got inflation, equity markets would hit a wall. The Tina argument, there is no alternative, is still powerful. It's going to take positive real rates to really upset things, and that feels like it's still a way away for me. And central banks might get involved anyway. But it doesn't mean we don't get different market leadership. If we get inflation, cyclical growth, we don't need to pay huge multiples for growth tomorrow, tech stocks, when we can have growth today, cyclicals and value, like financials, for example. So you would perhaps expect market leadership to switch from the darlings of the last 10 years, FANGs, to unlove things like financials, cyclicals, and possibly even energy stocks. And the same goes for commodities. In theory, in an inflationary environment, central banks can print money or they can't print oil or gold or property. So again, there, if people become worried about the loss of value of paper money due to mass printing or see inflation, history suggests they will make a dash for real assets, and then you'll see commodities outperform equities. So if the mood music changes, and remember, the first number one in the 1980s was Pink Floyd's Another Brick in the Wall, Dystopia. The last one in the 1980s was Jive Bunny. So that was a pretty big shift. And if we see a similarly big shift here, from low growth, low rates, low inflation, to inflation, higher nominal growth and higher rates, things might just change, and maybe, just maybe, commodities will come back and outperform equities, and that value will come back and outperform growth. It's certainly the sort of thing that we need to be aware of and potentially prepared for. Thank you for watching. It's good to see you again.
Thank you, Russ. Up next is a firm favourite presenter at Investival, and we are pleased to welcome him back. Studying accounting and finance at Dublin City University, our next speaker graduated in 1987. He is an experienced fund manager, and we're looking forward to hearing him speak today. Cormac Weldon's going to be looking at the current state of US markets. He'll address inflation pressures and outline what he believes the Federal Reserve will do to support economic growth. He'll also provide his outlook on the US economy for the future. Ladies and gentlemen, fund manager from Artemis Investment Management, Cormac Weldon.
Hello, I'm Cormac Weldon, and I work for Artemis, and I manage two North American equity funds. One fund is the US Select Fund, which is a all-cap fund, which means we can invest in very large businesses all the way down to smaller companies. The other one is a US Smaller Companies Fund, which, as the name describes, invests exclusively in those companies of, for us, less than $10 billion. We think both give a good way of investing in the US and covering all of the innovation, all of the economy, and hopefully all of the growth within the US equity market. Depending on the time, the progress of the economy can have a greater or lesser impact in terms of how we invest. So for instance, in 2018, 2019, the economy was growing relatively slowly and therefore was not having a great impact in terms of the prospects of businesses. But it's very different today. As we know, we have been coming out of a recession and there's been a lot of stimulus. And part of that is being provided by the government, so-called fiscal stimulus. However, we think that the likelihood is that there'll be less and less stimulus provided by the Biden presidency, because as I ask here, it's possible that Biden is already a lame duck. For instance, in the Senate, President Biden barely has a majority at all. And actually, when you look at it, Democratic senators can be very different in terms of what they want. You've got the well-known Senator Bernie Sanders, who is so-called very progressive, very anti-business, whereas on the other side, you have a gentleman called Joe Manchin from Virginia, who is the opposite, very pro-business, does not want many regulations, and those two people, as examples of the split in the Democratic Party, don't really agree on policy. So it's very hard for President Biden to enact legislation. Now, he is going to try to put through a $2 trillion, and that is $2 trillion stimulus package soon. But it is debatable about whether that will get through or not. If it does, I suspect it'll be the last significant piece of legislation of the Biden presidency. The good part about that stimulus bill is that it is not as large as Biden would have wanted, which means that the tax increases to pay for that bill, pay for that spending, will be less than we'd originally expected. So that's actually more positive for the US companies than we had originally thought. Another aspect of the Biden presidency is quite an anti-business tone. For instance, we've seen the head of the Federal Trade Commission argue that Facebook or now Meta is a monopoly. We don't think that's the case, and we are confident that the courts will decide that that's not the case. So again, it's a limit on what the Biden government can do. We have midterm elections soon, or in a year's time, in November 2022. We would expect the Republicans to gain the House of Representatives and possibly the Senate. So therefore, further reinforcing my view that President Biden is a lame duck, will not be able to get legislation he wants through. Something to note is a possible change in the Federal Reserve. It's possible that Jay Powell, the current chairman, will be replaced. If he is, it'll likely be by a lady called Lael Brainard, who's the governor of the San Francisco Fed. She is likely to be as dovish, meaning less likely to raise interest rates fast, as Jay Powell. So we don't have particular concerns about the Federal Reserve. In terms of the economic outlook and the tailwind that will provide for businesses that we invest in, we think the economy will be quite strong next year, growing at over 4%. And remember, that's in real terms. When you add inflation on top of that, it means that the top line growth of the US economy will be in a region of 6 to 7%, which is really quite fast and quite a driver of some of the companies we invest in. The reason the economy will do that well is that there's a high savings rate. People have accumulated savings during the COVID crisis because they haven't spent as much money, but also quite a lot of stimulus provided by the government. So therefore, it's a high savings rate. There's quite a bit of pent-up demand. People want to go out and spend. In particular, perhaps they want to travel, which they haven't done much of for the last 18 months to 2 years. We would expect employment and wage growth to be quite strong. So again, that's quite good for, obviously, for consumers. They'll have more money in their pocket, although that will be somewhat eroded by inflation. And then companies are in a very strong position and want to spend a lot on capital investment, expanding their business. We would expect there's a lot of debate about inflation. It's quite high at the moment. We had the highest inflation number in quite some time recently. We think part of that will start to roll over or reduce at some point next year when the supply chain issues that are certainly common to the UK but are significant in the US will start to be reduced, which means that there'll be more goods coming into the country. And then we think when there's more supply of goods, the price goes down. A perfect example would be the automobile sector, where because of a shortage of semiconductors, not so many new cars are being made, which means the price of used cars has gone up a lot. We don't think that will last much beyond next year. There are risks to our forecast. One is that there's an error by the Federal Reserve, perhaps they raise interest rates too early. We don't think that's going to be the case, but we'll certainly be keeping an eye on Federal Reserve policy. And then, one outside risk, it's not that significant for the US, would be that the Chinese Communist Party lose control of the Chinese economy. We doubt that'll be the case, but you never know. On the next slide, we look at the wage inflation. And we've headlined this, wage inflation is reducing inequality. And really, that's part of the benefit that we're seeing from the current wage inflation. This chart shows wage inflation by income level. So those on the lowest salaries are getting the biggest wage increases. Indeed, if you look at those on middle and upper salary levels, they're actually not getting significant wage increases. So again, that wage inflation that again is common into the UK, where we're seeing hospitality as an example, having increased wages, is benefiting those who need it most, which is obviously very good. On the next slide, we look at the state of the US consumer. Earlier, I mentioned the savings that US consumers have. And one suspicion that people had is that it was only actually the really wealthy people who had saved money and not the people on lower incomes. But this chart is a study done by the Richmond Federal Reserve. And what it shows is that, okay, yes, the very wealthiest, those with the most financial assets, have saved quite a bit, of money. But it also shows that those with less financial assets have also saved quite a bit of money. Obviously, some of that is money that was given to them by the government in higher unemployment benefits, but it's also some money that they've saved as well. So this is quite good for the economy because it means that we would expect consumption will be more broad and therefore help economic growth. On the next slide, we just want to touch on a couple of examples of companies that we are invested in, and really it's interesting that an interesting aspect is the recovery from the COVID crisis and what that means and how it's influencing businesses. First of all, Planet Fitness is a gym. It's a low-cost network of gyms. When we say low cost, it's $10 a month. The company motto is that they're the gym for people who don't go to gyms. So it's not an intimidating experience. They encourage younger people, but also they want to encourage women. They want it to be safe and amenable, so somewhere that people will want to go, even if they're not the most enthusiastic gym goers. One aspect of this that makes it an attractive investment is, first of all, it hasn't performed that well against the market. As you can see on this slide, it actually underperformed quite a bit, and where a number of companies were doing well, their stock price is doing well because people were anticipating an increase in demand. Planet Fitness did not do so. So it's lagged, so that means that it's attractive to us. The other aspect is that in the US, because nobody was going to a gym for quite a long time, a number of gyms have closed their doors and we believe will not open. And industry experts expect that 20% of the gyms that were open in 2019 will not open their doors. So therefore that obviously increases the attractiveness of Planet Fitness, who will be opening all their gyms. The other aspect of this and a lot of other companies is that they have improved their business during COVID. Obviously, people weren't going to the gym, so they developed an app so that their members could engage and do remote exercise classes, etc. And that is giving them a closer connection with their members. And obviously, they can save fitness programs and all of that on there, make it a much more personal experience. As I said, it's $10 a month. So really, an aspect of this investment is the ESG aspect, the social aspect of it, by making gym going affordable. And the company are adamant that they will keep that $10 a month offering for people. I mean, that's quite important, obviously, given health concerns, given people's desire to get out and exercise again after not having been able to do that for quite some time. Another social aspect is that They know their gyms are quieter during the summer. So for instance, they gave free memberships to students during the summer to encourage, again, gym going, and obviously hoping to nurture a favorable view of Planet Fitness, so that when that student has some money and wants to join the gym, that they will do that. Also from an ESG point of view, the company have had recent very strong improvements in governance, reinforcing the board of directors, and those aspects of the investment are also important. On the next slide, we discuss one other company called Pool Corporation. What they do is they provide the chemicals, filters, pumps, and lights that go into a swimming pool that somebody would have in their back garden. Now, this is obviously, or maybe not obviously, but this is a business that improved during COVID as, first of all, house prices went up during COVID. And secondly, obviously, people were working from home, presumably looking at it in their back garden and saying, actually, you know what, we'd love a swimming pool in our back garden, because there was a significant increase in investment for new swimming pools, particularly in the southern states. Also, the southern states in the US are benefiting from immigration from the colder northern and highly taxed states, and that's benefiting people. So there's a big backlog of new swimming pools going into gardens in the southern states of the US. Now, what Pool Corporation actually do is they supply the bits and pieces that go into a swimming pool that people need to buy every year when they close their swimming pool for the winter and then open it up in the spring. You know, maybe the lights aren't working, a pump isn't working, filters need to be changed, and obviously chemicals. Pool Corporation are the largest company in this business, and that gives them a lot of power. It gives them pricing power. It also gives them purchasing power. They've got more capital than all of their other competitors, so they can bulk buy at lower prices, which obviously benefits the investment. And they're just able to invest more. So for instance, when the contractor goes to Pool Corporation, they will have the pump that person needs, whereas smaller competitors may not have so. Obviously, this business is done somewhat better as investors are looking at all of the new swimming pools that are going to need pumps and filters in the future, but we would expect it to continue to do very well. That's the finish of my presentation. Thank you very much.
Thank you, Cormac. Next up is a very topical talk presented by Craig Cameron, Portfolio Manager from Franklin Templeton Investments. Now, Craig has a Bachelor of Science in Mathematics from Edinburgh University, and he's a chartered financial analyst. Craig's going to be looking at sustainable investing with a firm focus on climate change. He'll outline how you monitor companies and ensure that they do what they say they're going to do, and what the outlook is for climate change investing. Craig Cameron.
So I want to talk to you today about investing with a focus on climate change. And if I start with this slide here, you perhaps see an image that is often associated with the subject of climate change. And I think many people start the presentation with nice pictures of solar panels. But I want to contrast that with the reality of what climate change has caused already and could cause in the future. This is an image of flooding in Central Europe this year, a major issue that we've seen here in the UK as well. And I think the reality of climate change is starting to hit home as we see disasters and more extreme events happen on an annual basis. And the reason for that is we're already at 1.2 degrees warming out of the 1.5 that is discussed as part of the Paris Climate Agreement. In fact, if policy continues as it is, we're likely to see about 2.1 to 3.9 degrees of warming. And the risks there are not just about extreme weather. It's declining water supplies and public health risks as well. And so when we think about what we need to do to solve that challenge, it's really about taking apart this pie. If we want to decarbonize and reach a 1.5 degrees world for warming above pre-industrial levels, we need to hit net zero emissions at some point over the next two or possibly 3 decades. And that means removing this entire pie. It's not just about reducing some areas or being more efficient in other. We really need to take this apart piece by piece. And that's difficult. There's a whole host of industries and sectors that are impacted. It's not just renewable energy. If you look at iron and steel, for example, there, that first category, over 7% of emissions are associated with the production of those materials. And that's a very difficult sector to decarbonize. It's about using more recycled product. It's about potentially relying on power from green hydrogen, for example. And unfortunately, while we've seen progress recently at COP26, there's still more that needs to be done. We saw absolute carbon emissions fall in 2020, but they're now expected to rise in 2021 by almost 5%. And while there's been a whole host of national long-term targets, particularly around net zero, a lot of these lack the short-term plans that are more meaningful for implementation, and they're not enshrined into law either. In fact, just 21% of global carbon emissions are covered by a carbon pricing scheme, which ultimately we think is the main way in which markets and finance will be able to sort of combat and price carbon effectively. Many of these are still priced far too low to affect change, and there remains a patchwork of regulations, even around in one country, for example, not just across the world. And this work done by MSCI recently, their implied temperature rise analysis paints a pretty negative picture of the economy. You can see here that sectors like energy, materials, and utilities, are not particularly compatible with a 1.5 degrees warming scenario. In fact, the vast majority of companies in these sectors are compatible with a temperature rise of 3 degrees or more. And so there really is a challenge in decarbonizing, particularly some of these heavier industries, and getting companies either to set more aggressive targets or simply invent new technologies. Overall, the analysis showed that the average company is aligned with a scenario about 2.9 degrees warming relative to pre-industrial levels, which unfortunately is not enough and is likely to cause significant destruction and disruption to the global economy. Now, that all sounds very negative and sort of sets the scene and the scenario, but I think what we can see here is if we do want to get towards a 1.5 degrees warming scenario, there's a meaningful gap between the pledges and targets that have been set and this lower sort of green line outcome where we do actually manage the carbon emissions that we have in the economy. And the important thing from an investment standpoint is that shift creates big opportunities. Every time an industry goes through disruption, we see new winners and new losers being created. And this is almost a unique set of circumstances where almost every industry will need to be disrupted over the next 10, 15, or 20 years. And so that creates huge opportunity. Here are the two probably most obvious examples. If you compare the current sort of renewable energy generation, it's about 13% of global consumption. If you believe the green scenario that is compatible with 1.5 degrees warming under Bloomberg's New Energy Finance, they see 85% penetration of renewable energy by 2050. So wind and solar are not near-term growth markets. They're growth markets that will last for 20 or 30 years. And we will see huge expansion in renewable energy for the very long term. In fact, electric vehicles are transitioning even faster. We've seen these forecasts rise dramatically over the last 2 or 3 years as car companies have started to realize that if they don't make electric vehicles, that in the next 10 or 15 years, they might not be making any vehicles. The economic argument for electric vehicles has certainly become stronger. And we believe over the next sort of 10 or 15 years, most car sales will become electric as our infrastructure shifts away from internal combustion engines towards more sustainable methods of transportation. So as an investor, there really is a unique set of circumstances where we have political momentum, we have consumer awareness. There are initiatives and regulation, things like the Net Zero Asset Managers Initiative, that are really driving capital towards these areas. And as money is shifting into these sort of opportunities, the cost of capital is changing. If you compare the oil and gas sector with the renewable energy sector over the last decade, there's been a huge swing in the cost of capital for these companies implied by share prices and stock markets. In fact, one could then see that being applied by, for example, the oil and gas sector as it continues to invest in renewable energy today that it would not have done perhaps at a level 10 years ago or so. And really that shift in the market is being created by investors pricing in that sort of long runway of growth in renewable energy. And I think active strategies are, can take a special place in sort of engaging with management and really helping to drive change. As an active manager, you have an opportunity to sort of speak to management, be able to influence their decisions, but also have the sort of threat of divestment, where you can invest in other companies in the sector that are perhaps taking a more aggressive approach. And so there's multiple ways of doing that. As an active investor, we can sort of engage with companies to help them set more aggressive carbon targets. Companies that are aligned with a 1.5 degrees warming scenario are less likely to see higher carbon taxes or face regulation from governments and so on. Companies that set more near-term meaningful targets are then able to sort of demonstrate to investors progress along the way. And companies that are signed up to science-based targets initiatives are then able to be independently verified in their targets and their approach to reducing their carbon footprint. That's not all. When it comes to smaller companies, there's a real focus on improving disclosure. Here, the opportunity for active investors is about pushing companies to recognize the problems or the carbon footprint that they have. Understanding, let's say, their carbon emissions, maybe their scope 3 emissions, and also just improving their disclosures. So, for example, signing up to the CDP, reporting properly, and producing sustainability reports. All this helps us to understand the challenge that we face and helps us to track companies as they decarbonize. And lastly, implementation. There's a real role for active management in ensuring that executive compensation is tied to targets related to ESG metrics, including climate change. Companies can, adopt an internal carbon price that helps them to understand the financial implications. And it's also about engaging with management and making sure that companies are truly delivering on their emissions reductions. All of these combine to create a competitive advantage for companies. And I want to make the case that investing with a climate change focus is about finding companies that are going to outperform in this environment as climate change becomes an increasingly important driver of stock market performance. That can be seen in some studies. This is one historical that looks at performance on material ESG factors, where you can see that companies that adhere to material ESG factors and really focus on those issues, that sort of top left bracket, are the ones that have tended to outperform their peers the most. So how can investors think about this? Well, in our strategy, we think of three different types of companies. Solutions companies are those that are providing products or services that help reduce emissions. These are companies benefiting from growing demand. The regulation is moving in their favor, and new opportunities are being created all the time as regulation shifts and as we become more aggressive with decarbonization. Resilient companies have insulated their business from the risks of climate change and might benefit because they pay less carbon taxes and that sort of thing. And lastly, transitioning companies. These are companies that are shifting their business either to provide more solutions or to become more resilient. And looking across all industries, we see a world where new winners and new losers are created. And investing with that climate change focus helps us to understand those winners and make sure that those are the companies we're investing in. We break our fund down into 8 different buckets within solutions and transitioning. And really, it's not just about renewable energy or electric vehicles. There's a wide range of opportunities associated with climate change and great opportunity for diversification, even within the theme. Thinking about our funding specifically, our approach has been to take a sort of dual benchmark. We have our performance objective, which is to increase value, and we compare ourselves against MSCI All Country World Index. But we also have a climate change reference to compare our climate change objective, which is to contribute towards mitigation and adaptation of climate change as considered by the Paris Climate Agreement. We think an increasing number of funds will have this dual benchmark structure in the future, and it will be important to be able to show that your fund is contributing towards climate change while performing as well. Thank you.
Thanks, Craig. Now, Abby Llewellyn-Waters is Head of Sustainable Investing and Fund Manager of the Jupiter Global Sustainable Equities Fund. Since joining Jupiter Asset Management in 2006, she's dedicated her investment career to sustainable investing, with her team building and designing a rigorous investment framework that embeds all stakeholders into fundamental stock analysis. She's multi-award winning and has received recognition for her investment performance, her approach to ESG integration, and her contribution to address the structural hurdles that women in investment face. She also collaborates on several industry initiatives, including as an author for the CFA Institute on its Climate and Investing Certificate. She's an ambassador for the Diversity Project, is a member of the 30% Club Investor Group, and has a degree in classics. Today, Abby will take us on a whistle-stop tour of the challenges faced by companies in adapting to the fast-changing regulatory environment, how important it is for companies to embed sustainability, and what it means if they don't. She'll also touch upon COP26.
So today I'd like to talk to you about the fast accelerating landscape that we are seeing within ESG investing. And the first point I would like to make is that we've been doing this for a very long time at Jupiter and are well positioned to support you and our clients navigate this fast accelerating landscape, launching our first fund in 1988, over 30 years ago, and long-standing members of the responsible investing community. So with that, one of the aspects I'd like to focusing on is the acceleration aspects that we've seen in recent years. And the first point that I would like to make is in January in 2020, the World Economic Forum every year gets together to decide what are the top economic risks to the global economy. And in January 2020, it was a historical moment because the top 5 economic risks were all environmental. So what you see here is along the x-axis, along the horizontal axis, you see the likelihood of an event happening. Along the vertical, it will be the impact of that event. So that top right-hand corner is highly likely, big impact. And you'll see those 5 environmental risks broken out there. Extreme weather, government inertia around policy, biodiversity loss, natural disaster, and human-made damage. And what I want to make the point is, this isn't political, ideological, or values-based risk. These are economic risks. And for those of you with very good eyesight, you will see that we have circled in red infectious diseases. So at the time, in January 2020, pre-pandemic, when most of us didn't know the definition of epidemiology, the World Economic Forum considered infectious diseases, and by extension pandemics, to be unlikely but significant impact. If we fast forward a year to January 2021, you will see infectious diseases has moved up the likelihood aspect of their predictions. But interestingly, all other risks remain environmental, and what we also see coming into the mix is social inequality. It's a really interesting development from that perspective. One of the aspects that we get asked a lot about is carbon measurement. And carbon measurement in the context of those environmental risks that we've just discussed is measured across 3 different scopes. Scope 1 or 2, there is an element of standardisation in how we measure those scopes, and you will see them highlighted here for you in this illustration. So company facilities and the energy used to power those facilities, so think offices, manufacturing, factories, etc. But the vast majority of the emissions from an environmental impact perspective sit within Scope 3. And at the moment, we are very nascent on the journey in being able to measure those emissions. And if we go to look at what's broken down in the upstream, downstream considerations of Scope 3, you can see the complexity and variation of inputs that go into a single Scope 3 measurement. And I've highlighted their use of sold products. So if we think about an example of a car, the Scope 1 or 2 is the emissions produced from the buildings and the energy used to power those buildings in the manufacturing of that car or selling and marketing of that car and administration aspects. But the moment the car leaves that factory, that goes into your Scope 3 downstream, and that use of sold product, the rest of the lifetime of that car's environmental impact sits after it has left the showroom. And so from that perspective, when we're thinking about the complexity around these issues, I want to frame our conversation with that in mind, that we are nascent in this journey of standardisation. It is vast, it is complex, it is nuanced. And so when we talk about these issues, and when you're thinking about it in your own savings and asset allocation decisions, I want you to be aware of where we are on this journey. We have a go at Jupiter at measuring the emissions of the global sustainable equity strategy, because we see it as a very important input to our understanding of a company's long-term position. But you will see here exactly what I've said. Scope 1 and 2 is a relatively low carbon profile, where the biggest impact the companies that we invest in have are on their Scope 3 emissions. And be mindful of that when you're looking at net zero alignment within your own portfolios that supports a 1.5 degree climate scenario. So let's go forward. One of the other aspects that we see great intersectionality with is the social factors. So where the pandemic has accelerated the environmental considerations, it's exacerbated some of the social goals. So we see here the predictions of global poverty. It is the first uptick in global poverty as a result of the pandemic since 1998. The UN Sustainable Development Goals, social-orientated goals, have been set back by several decades. And it's not just a developing market issue, it's also a developed market issue. Here we have the unemployment rate in the United States. And the top line there is adults over the age of 25 who left school with no high school diploma. The bottom line is those adults with professional qualification. And you will see in April last year, when the pandemic hit, the unemployment rate of adults with no qualification, the most vulnerable, the least able to navigate unemployment in the face of a humanitarian crisis, saw their unemployment rate go from 6% to 22% in the space of 4 weeks. There's significant fragility within the economic construct. So when we think about capital allocation in the context of delivering sustainable goals, bringing in social equity at an intersectionality to environmental impact and economic return is absolutely key in our view. And if we go forward, we can see the policy response, a huge response from the Biden-Harris administration in the US as how to address some of these inequality factors, specifically targeting those low-income vulnerable families. What does this mean from an investment landscape perspective? Well, we've had regulatory legislative response to the landscape that I've presented. We've had a cooperation statement from the two largest emitters of greenhouse gases, that's China and the US. They have agreed to cooperate. They first agreed in May this year when John Kerry flew to Chinese soil to broker or negotiate that diplomacy exercise. But we've also seen it repeated this week at COP. So this is a huge result in the context of the reliability of these legislative targets. This is legislated decarbonisation of economies at a national level. From a regulation perspective, we've had the very well covered UN Conference of Parties in the context of climate in Glasgow. We also had the UN Conference of Parties for biodiversity in China a few weeks prior. And with that, we've got something called TCFD. TCFD is the Task Force for Climate-Related Financial Disclosure. And you should be aware that the G7 have committed to make it mandatory for companies to report their climate-related financial risk within the framework presented by TCFD that most importantly includes scenario analysis. You also have TNFD, the Task Force for Nature-Related Financial Disclosure, which will look to follow a similar path to climate-related financial disclosure, focusing on natural capital. Over half of the world's global GDP is reliant on natural capital at the moment. We have to address the fact that the economy is living outside of its planetary boundaries. So the regulation is taking shape, the legislation is set, and if we go forward, what does that mean from an investment perspective? So for us, when we're investing in companies, we have a very simple philosophical outlook. We want to invest in the highest quality companies leading the transition to a more sustainable world. And we balance quality by consideration of three core stakeholders. That is the planet on which we all depend, the people with whom we all coexist, and the profit that we all require for our long-term savings. And the reason that we do this is very simple. We think those companies who balance those broader stakeholder needs are better positioned to deliver more attractive returns. It's so important for this asset class to demonstrate the additionality that it brings. This isn't just about economic return, this is also about environmental impact mitigation and social equity. So for us, that's a really important part of our investment framework, and evidencing and providing our clients with transparency on how their savings support and address the urgent landscape that we've set out for you today. So evidencing in an annual impact report exactly the real world outcomes that are supported through an investment framework that considers this landscape and embeds it with an investment framework. Now, many of you may have seen this meme. It is done by a Canadian cartoonist, political cartoonist. You can see here the inference or the implication of these externalities that we face from an economic perspective. We saw the World Economic Forum identify those risks. But what is very clear to us, who have been doing this for many decades, is these externalities are very quickly going to impact the economic returns of companies. The externalities will no longer be a byproduct of business, but an internalized cost of business. And that impacts companies' profitability through their margins, or it impacts their market share if they pass those costs through. Companies who are mitigating those risks, changing their processes, avoiding that environmental impact, are intrinsically better positioned on a forward basis. And we see that here, and those externalities and those existential risks that we face on a capital markets basis. So very important to think about capitalism in the context of regeneration on a social equity basis as well, where human capital across the supply chain from employees, customers and suppliers are better represented in investment and capital allocation decisions, because we see that inequality and the fragility that needs addressing, and how companies address that we think will be important to their own economic resilience. One of the things that we hear is that if you think like this, you sacrifice returns. And that has not been our experience. You can embed broader stakeholder outcomes and deliver excess return in doing so. One of the other things that we hear is that there is excess risk involved when you consider broader stakeholders. That has not been our experience. We've been able to generate attractive returns, giving full consideration to broader stakeholder balance in the planet and people, and not take on excess risk. So with that, we'll close this session for you, but I hope you have a sense of the urgency, the acceleration of the landscape, what that means for investing in the opportunity from a savings perspective to align to a more sustainable world, and having a deep specialism and understanding of this landscape is important to get the real world outcomes that we need to address some of those existential risks that we've highlighted. Thank you.
Now, next up, we have a new speaker to our Investival event and one we're really looking forward to hearing from. Now, this speaker was born in the Kenyan capital of Nairobi, whilst his parents were on safari there. He's lived briefly in Tanzania. He spent a couple of years in both Malaysia and Japan, where he went to school. He practices Qigong yoga and intermittent fasting. Intermittently. With 21 years experience in the industry under his belt, today this speaker will address Asia and China. He'll outline the new opportunities currently creating value in Asia and address the changes he believes will propel productivity forward in the region. He'll also outline where he sees investment opportunities as well as potential risks and provide some insight into his investment strategy. Ladies and gentlemen, from Crux Asset Management Fund Manager, Evan Markson-Brown.
Today, I wish to take you on a story of a world facing unprecedented technological change and disruption. We believe that societies, politics, economics, and the social fabric of our world is under unprecedented change. This is happening globally and is happening at a rate which is much faster than we've ever experienced before. Within this world, we believe that Asia ex-Japan is actually very well positioned to benefit and capture from this global disruption. And why is that? Because they have the adaptability of change. If you look at the bottom of the chart, this is Shenzhen 40 years ago in 1980. Fields, rice paddies, and a small town or village. 40 years later, it's a metropolis, one of the largest, fastest growing cities in the world. The Asian consumers, and especially the Chinese populace, has seen so much rapid change in the last 40 years compared to us in the West, that they're far more likely and able to embrace change in their lives, different lifestyles. It also means that the populace is far more fickle in the way they look at brands, the way they go to different platforms, the way that their consumer habits change. And therefore, what we're seeing is far more dynamism, investment, and innovation coming from some of these markets. We believe that Asia ex-Japan will be the fastest growing region in the world over the next 3, 5, 10, 20 years into the future. And that's obviously driven by favorable demographics, the rising middle class, and urbanization. But it's more than that. It's that rapid adoption of new technology, which is creating all this innovation, all this excitement, all this disruption, and all this change. And why is that, again, happening faster in Asia? Well, you've got the younger population and the demographics. You've got less sunk costs. What do I mean by that? That means it is far easier for China, which has failed to really build up an industry in the old ICE automobile industry, to leapfrog into electric vehicles, or to leapfrog into 5G technology, or to leapfrog into short-form social media e-commerce. And lastly, coming back to that earlier point, the population is more adaptable and therefore far more willing to embrace change. My last point is what I call financialization. And this really is a 5, 10, 20-year story. At the moment in China today, about 2% of all Chinese consumers' net wealth is in financial markets. The rest is, as you can see, in properties and cash. We think that's going to have a dramatic shift over the next decade. Why? Because the Chinese property market has probably peaked. You've been earning double-digit returns for the last 20, 30 years. My guess over the next decade, that's going to struggle to keep in line with GDP. The shift of wealth towards equities probably means by 2030, 2035, Asia will be the largest consumer market in the world, the largest economic bloc in the world, and the largest financial market in the world. How do we think we can make money from that? By looking for change, investing long term. We say anticipate change and embrace uncertainty. The bubble chart here shows how our portfolio is currently positioned. And really, this is the Asia consumer front and center to everything we do. We've got the fourth industrial revolution, we've got lifestyle, but maybe let's really concentrate on two areas. Let's start with the bubbles below, the electric vehicle transition, the energy and renewables transition, and the commodities which that involves. We're probably going to have somewhere between 10 to 20% of world GDP completely disrupted and revolutionized over the next 2 decades. We don't know how that's going to happen. There's going to be lots of bumps in the road. Some of the projects will fail and become unworthy. But what I can tell you is that you're going to have to embrace change and invest very heavily to work out who the long-term winners are. There's 3 things that I am certain will happen in this big disruption. The first one, China is going to become the world dominant supplier of electric vehicles and their components, of renewable technologies in solar and renewable technologies in wind. The world energy transition is going to use more energy, especially coal and fossil fuels, to get to renewable utopia. And lastly, the commodity intensity of GDP will have to rise because all of these technologies use more copper, lithium, and nickel. So how do we play this? Well, first, let's talk about e-commerce. Now, clearly this year has been not the best year for Chinese e-commerce. There's been lots of noise. Let's just take a step back. The Chinese e-commerce market has been fantastic, growing really rapidly over the last decade. But as you can see from this chart, this is Chinese online GMV. It has been slowing, and in the last couple of years, especially this year, it has slowed quite rapidly, just above GDP growth. What is coming next? Well, you've had not only the slowing of the overall market, and that's really due to China leading the forefront of e-commerce penetration, and many goods and services are now over 50% of total have already moved online. The government, in the next 5-year plan, is only targeting 7% retail sales growth, and that equates to about 11% in e-commerce. But probably most importantly, and what most people seem to have missed out, is that competition has risen. It is far less barriers to entry in China than in almost any other market in the world. And that means the incumbent, Alibaba, has continued lost market share, and in our opinion, will continue to do so. But that provides huge opportunities because growth has moved on. Let's take Data Nexus here. This is last mile O2O delivery. Get a product delivered to you in average of 25 minutes from when you order it. 530 million customers, 100,000 retail outlets which will deliver door to door. In the single-day sales this month, their white goods, home appliances were up 10x from last year. JD.com still compounding its revenue 20% year after year. JD Health, we think it will grow 50% compound growth rate over the next 5 years in online sales. So let's go back to that electrical vehicle supply chain. The supply chain stuff is really tricky. Elon Musk, what do you kind of mean by that? What he really meant was the US economy cannot provide any other parts of the manufacturing. It's all in Asia. And to be frank, it's pretty much mostly in China. You can see the car there. So let's take the biggest part of an electric vehicle. It's the battery. Who are the global dominant people in batteries? Well, it's CATL in China. It's Samsung SDI, LG Chem in South Korea, and Panasonic. We believe that China eventually, because of scale, will become the largest supplier of batteries in the world. And what does that mean? It also means that all the suppliers, the catalysts that go into batteries, the separators, all of that ecosystem also ends up in China. And that gives scale and that gives cost competitiveness to the Chinese ecosystem. And that, as you can see in my portfolio, these are all the stocks we're playing within the battery side. But we also think within the OEM business. So these are original automakers. We all know about Tesla. We've probably all heard of some of the Chinese wannabe electric vehicle companies, NIO, Li Auto, etc. how is the world going to change? We think we're at a point where the disrupted are actually going to start being the disruptors. So over the next 5 years, electric vehicles are going to go from hype to reality. We're all going to start seeing them in our showrooms. Every single manufacturer is going to have one. In fact, those manufacturers which are small and can pivot faster to electric vehicles probably going to will benefit far more than those who are old and cannot. So for example, Tata Motors in India has announced that Jaguar is going 100% electric by 2025. And they probably will have the largest electric vehicle division in India of any company. Or Hyundai with its 10% electric market share and moving into a future technology, which is hydrogen. So taking a step back, we believe, as we said at the beginning, that the world is facing unprecedented technological change, which is going to affect all of us. We don't know exactly how this will happen, but if you are happy to anticipate change and embrace the uncertainty that brings, then there are huge amounts of opportunities in countries, sectors, and individual companies which can drive very long-term value and growth. And that is why we've set up the Crux Asia X Japan Fund to benefit within the region. Thank you.
Our next speaker has been managing funds for over 20 years, having started his career back in 1998. Alongside being a fund manager, Simon's also played international cricket for Alderney and the Channel Islands. He played against Portugal and Spain and was the top scorer in both matches. We'll have to get him to give Russ Mould some pointers. Amazing. Ladies and gentlemen, from 91, fund manager Simon Brazier.
Thanks, Danny. So today I'm going to be talking about the UK equity market, the macro environment, and the 91 UK Alpha Fund. Before I start, I think this is probably one of the most interesting and also most uncertain times as an equity investor. We're in a period where, interestingly, we have very elevated stock markets at the same time as probably some of the biggest macro risks we've seen for a generation with inflation and growth uncertainty. So I want to try and address the balance between those today in this presentation. I'm going to start with a macro summary, and it's interesting that for a lot of people, the mantra today is that post-pandemic, post-vaccine, we're entering the roaring 20s again. It's going to be a wonderful time as we come out of this pandemic, and that we're going to have strong economic growth, and at the same time, consumers rebounding back and companies in rude health. I'm not always a fund manager that is glass half full, and I do have some reservations about that sort of outlook. And at the moment, as we know, actually, if you take these numbers here, these are the OBR's numbers for growth forecast for the UK, what you'll see is, despite actually quite aggressive assumptions around consumers, the savings ratio back to an all-time low again, them spending pretty much all their disposable income, and businesses reinvesting post the pandemic, we're only really seeing 1.5% on average GDP numbers going forward. That's quite muted relative to history. Not only that, as you would have all know, we're seeing inflation coming through, rising manufacturing prices on this chart here, difficult delivery times. And the big question is this inflation transitory? The Bank of England today is still sticking to its guns. This is their chart showing inflation getting back to the 2% target over the sort of next few years. But Andrew Bailey, I think, is sitting quite uncomfortably, worrying whether actually this inflation could be more sticky. And that is an incredibly important point. And the reason I say that is because for the last 40 years, we've been in the same macro environment, an environment of one where effectively it was known as the sort of neoliberal era, independent central bank, supply side reform, where when things got difficult, initially we cut interest rates. In the 70s, we were sitting at 16% rates. Today, we're at 0.1%. That ammunition has now run out. And once that ran out, we moved to quantitative easing. QE, back in 2007, 2008, was known as the short-term, non-conventional monetary policy that was going to help provide solvency to the financial system. And yet here we are today, over 10 years on, and it's become a long-term conventional monetary policy providing liquidity to the financial system. But there is a big change afoot. The Fed, the Canadians, the Kiwis, the Australians, and now the UK Monetary Policy Committee is indicating that for the first time we are going to maybe have tightening monetary policy. You'll see from this page here, they're talking about at interest, if we get to policy rates of 0.5%, that they would then stop repurchasing gilts through the QE program. And at 1%, they would actually start selling the gilts they use through QE. And this is something I've been talking about for some time. QE is not something that doesn't have consequences. QE ultimately cannot go on forever, and the party may have to stop. And I think we're closer to the end. And this for me is a very, very scary chart. What this shows you is in black, the black line is the government's net issuance of gilts since the beginning of the pandemic. How much bonds they've had to issue to fund government spending. £440 billion worth. The red line is what the Debt Management Office has bought, is what the Bank of England has bought in terms of QE. Almost pound for pound matched. So Mark Carney once described the UK as living from the kindness of strangers because foreigners bought our gilts. Actually, for the last few years, it's been the Bank of England that has been buying the gilts. We've been living at the kindness of them. But that party is over. And Rishi Sunak was probably taken into a dark room by the Bank of England and said, we're no longer here to back you and buy every single gilt you want to issue. And therefore, it is no surprise that we are seeing fiscal tightening. All of us will be paying higher national insurance contributions going forward, and there may be more to come as Rishi tries to balance the books, knowing he can't just keep issuing debt, particularly now the country is nearly at 100% debt to GDP levels. So the big question from here is, what happens to this chart on the left? We're not in an environment where you can see here, on average, interest rates would cut 5% in every loosening cycle. What happens to interest rates from here is very important, and particularly when you get to the zero rate band where we nearly were. Just small changes in interest rates can have a big effect. And the Bank of England has already come out and said that roughly every 1% increase in mortgage rates reduces disposable income by about 10%. That could have a profound effect on the UK economy. So finally, this picture for me describes it. There is a significant amount of debt out there. It does constrain growth. Longer term, I do think it will constrain inflation. But from here, my summary is very much that, yes, the recovery is now underway. The banks, the monetary authorities got their global financial crisis playbook out and used QE to support the system. But actually, banks now, the Bank of England is potentially in a tightening phase. And from here, what does that mean? It means we better have growth, because otherwise stagflation could rear its head and we could be in a pretty tricky place. And from the market's perspective, what happens to the yield curve, the cost that ultimately we borrow at, it's not the Bank of England rate that sets mortgages, it's the yield curve that sets mortgage rates. That is going to have an incredibly important outcome, and as the inflation and the deflation bulls and bears do battle. So let me come on to the market. I'm only going to spend a little bit of time on this, but as a UK equity manager, it's been a pretty tricky place to be while you've seen all the other equity markets roar ahead post-pandemic, and the UK has certainly lagged. A lot of that has been down to the valuation performance of large cap. You can see here that large cap stocks now at sort of 12, 13 times earnings are some of the cheapest you can find globally. And you can see that mid and small cap has performed very well. There's also been this strong star rotation, where you've seen value stocks doing very well in the more recent environment, particularly with rising interest rates. But interestingly, growth still has continued to go up. And that has meant we are seeing very, very elevated valuations for growth companies right now. Some of the UK stocks I look at trading on 50 times earnings, just valuation levels that I can't stomach to buy, because ultimately I want to buy low and sell high. So briefly, what are we therefore doing in the fund? This is a fund where our philosophy has always been to buy low, sell high, to work out what companies are worth on a medium to long-term view. The inefficiency we exploit in markets is the long-term valuation opportunity in companies. We will use short-term volatility to exploit the long-term valuation, but ultimately I want to have a good set of companies that I hold for a long time. Turnover is well below 20% in the portfolio, and we are running a diversified portfolio. So we look for companies with great business models that ultimately grow their profits over time, but importantly turn those profits into cash. Right now, there's a lot of companies who don't even generate cash on very significant valuations. And a lot of people say, Simon, don't worry about valuation. With these interest rate levels, valuation is irrelevant. Valuation is very important. And you'll see here, it is cash flow based valuations that we focus on, because your clients give you cash and I invest that cash on your behalf, and we need cash back. Capital allocation, incredibly important, how companies reinvest that cash flow. That's the difference, obviously, more often than not, between a good and a great company. We do focus on sustainability like everyone else. It's becoming increasingly important. But at the end of the day, I want to make sure I own companies that can still continue to grow. Finally, risk and reward. Fund management is about risk and reward. It's not all about the reward. And the risk I'm managing is your client's risk. It is the risk that they lose money in an individual company. They're not invested in AJ Bell or 91. They're actually invested in the likes of Unilever or Diageo or Ryanair, the companies I own. That is the outcome for them. And so I manage the portfolio based on business risk. All things being equal, higher position sizes in companies with less business risk, and also using diversification. So on the right-hand side of this chart, you'll see I want to diversify the fund by investment theme, growth driver, style, market cap. I don't want it to be one bet on growth or rising interest rates or a certain type of technology. So putting that together in the portfolio, this is what you get. This is the fund. The top two boxes are the stocks I own through the cycle. They're the companies that completely fulfill the criteria: a great business model, great financial model, great capital allocation. They're typically globally diversified, cash generative, defensive businesses. They haven't really helped me that much in 2021. They very much helped me in 2020. I will buy restructuring recovery, companies where there is a catalyst for change, and I will buy cyclical growth. But it has to be growth where valuations protect me on the downside. And what you'll notice here, I have a lot of sort of COVID recovery stocks, the likes of Ryanair or JD Wetherspoons, whose revenue volumes are not back to where they were during the pandemic, but I'm a long-term investor. I can wait for the next 2 years, but once Ryanair and EasyJet are back up and running, I promise you, my belief is that those valuations will then significantly increase. And finally, we do have some interesting businesses at the bottom. The likes of Essential, a fascinating business that's all related to consumer data, an area of data that is being underpenetrated and is incredibly important for the likes of companies who are trying to position themselves on Amazon. They have a business called Flywheel that helps the likes of Diageo sell their products through Amazon. It's an incredibly high growth business. So what are we doing in the portfolio? As I said, the macro outlook is relatively uncertain. The scarring of the pandemic is certainly going to be more severe than I think people think. And I'm not in that camp of the sunny uplands. Consumers remain stretched and governments are indebted. The corporate sector, to be fair, is in relatively good health in their balance sheets, which is a good thing as an equity investor. But valuations are pretty full at this point in time. That is critical. And hence, there are many companies I'd love to own, but for me, they are too expensive. So we're not going to get carried away with buying overly expensive companies at this stage of the cycle. We are therefore cognizant of the risks. Liquidity risk, liquidity in the markets today is pretty dismal, to be honest. There's economic risk, as we've discussed, and also one has to still remain awareness of currency risk. We are wary of economic cyclicality unless valuations protect us. The shape of the yield curve is going to be incredibly important, and I continue to focus on balance sheet strength, earnings certainty, and defensive cash flows. My long-term track record is one where this shows rolling 5-year period since 2006. If you've bought the fund, gross of fees, at any point, any month since 2006, we have beaten the market with it if you owned us for 5 years. That is what we're trying to do. We are long-term, stable, safe, secure investors who are trying to find companies that we can own for the long term. So in summary, yes, there are significant economic headwinds. We need to be careful of that valuation polarization, not getting caught by the value traps on one extreme or the high growth companies that are overvalued at the other extreme. There will be volatility from here. Style, sector, size, and stock volatility will continue. And a lot of that relates to how the yield curve moves. And my job, on behalf of your clients, is to own companies that can negotiate and navigate a world of geopolitical stress, economic uncertainty, and structural change. Thank you very much.
Time flies, and it is now time for a 5-minute coffee break. We'll see you again shortly. Welcome back. Our next speaker is John Patullo, Portfolio Manager from Janus Henderson Investors. John has a Master's in Economics from the University of St Andrews. He's a member of the Institute of Chartered Accountants of Scotland and an associate member of the Society of Investment Professionals. He has 28 years of financial industry experience, so as you can guess, he knows his stuff. Today, he'll discuss whether central banks can really control supply-side inflation. He'll look at the effect the bond market has on central banks raising interest rates, and he'll outline why unemployment is so low. Ladies and gentlemen, John Patullo.
Thanks, Danny. Hello, I just want to give you a bit of assessment on the post-pandemic landscape from the Janus Henderson bond stable, really. And there's a number of things going on in a structural and a cyclical sense, and hopefully you'll find it interesting. One of the first ones is actually borrowing some research from the San Francisco Fed, which really looked at what happens to real bond yields post-pandemics compared to wars. And we're not talking an immediate response, but a longer-term structural response for the next couple of decades. And as you can see in the top left chart, generally after a pandemic, real bond yields are structurally lower for a number of decades after the event. And that's really in contrast compared to wars. So, in a war, you've got to rebuild the economy, you've got to rebuild the infrastructure, and there's demand for capital to build things because capital has been destroyed. And really on the back of that, you expect real interest rates to be higher structurally because there's more demand for investment and less for savings for a long time. Whereas in a pandemic, nothing has really been destroyed, nothing has to get rebuilt. There's plenty supply side capacity. And, I think that makes a lot of sense to us. The one thing, what is true from previous pandemics is generally there is a bit of a shortage of labor. And that's actually happening in this pandemic, not so much from deaths, but really due from people not participating in employment. So, the Black Death, the Spanish flu and so on, the evidence would suggest, albeit from a low sample size, is that people have a bit more wage bargaining power because given those pandemics, there were less people around. So that's hopefully just a little bit of a flavour watch where the next couple of decades may be going structurally lower real interest rates going forwards. Now, moving on, I think, and we've written about this on our website, a lot of things have changed post-pandemic, not just the way, we may not go to the cinema, we may stream straight into our homes the films that we want to watch, but the way we shop, the way we might go to a restaurant and the menu might be on your iPhone, you might pay on the iPhone and all that sort of stuff, let alone the way we may exercise, maybe on our exercise bikes at home and not going to the gym, in the way that, our wallet is really our mobile phone now. And in America, your driving license can be on your wallet, or your credit cards are on my wallet, my mobile phone. Not good for wallet manufacturers, and so on. Let alone the working patterns that we've all got used to. We're currently working 2 days a week up in our office, and that will have a material effect on my daily coffee shop routine, or I don't need a season ticket in London to go up to the office. I just pay as I go. So a lot of things have changed here, and I think aren't really going to go back to as they were. And as an investor, you really got to think about that and the way that people spend money, their behavioral patterns and so on. As you know, there is a glut of savings going on, and the debate is really out there whether that money is going to get spent or whether there's a bit of precautionary saving which might hang around for a while in the global economies. And those behaviors, the research says, it normally takes about 66 days for behavior to kick in. So I'm not boiling my daily cup of coffee up in London because I'm not going up in London or right through the week. So these things change, and then arguably you actually look, well, actually maybe I didn't need that daily cup of coffee or whatever. And it's much easier to shop from home, as I'll show you in a second. But some of the big drivers of GDP historically have been obviously GDP growth, and that is driven very much by population growth and migration. And America actually had the worst population growth for 50 years last year. Their fertility rate is roughly 1.4. Global fertility rates are actually really low post-pandemic. So that's a slightly unusual thing that people haven't, I guess, the confidence or want to reproduce. And that long-term structural trend in fertility has been around for years, but it's been accelerated by COVID and the digitalization we're seeing around the world, let alone countries like, well, Europe and Australia and America have been big beneficiaries from migration. So Australia normally takes about 300,000 people on a population of 26 million into their economy. That's one of the ways their GDP has been so strong, is they've recruited skilled, young, skilled people into their economy. And that's all been completely shut down given the epidemic. And these things are massively topical for the way the economies may or may not grow going forwards. World population growth was forecast to peak in 2060, but recent evidence would suggest that's nearer 2050. So if you like, there's a bit of a baby bust going on, and fertility rates weren't good anyway. Final point is, don't confuse cyclical and structural things. Cyclical trades in an equity sense really is the difference between growth and value, but we very much look at structural trends as well. And structural trends really separate winners from losers. And the thing about losers is they don't mean revert, they go bust. So I would see shopping centres or some shopping centres or maybe cinema chains as structural losers, whereas as investors, we would all back the structural winners. So we've always liked Netflix. We liked Netflix before COVID. It's obviously had a fantastic COVID, and it's a structural winner going forward. So we always try and make that distinction, and we try and lend to large cap winner businesses, tend to be American, or tend to be global businesses, tend to have a digital policy, and have really accelerated that digitalization in their strategy going forwards. And as a bond investor, that's very much what we're focusing on. Just very briefly, this is some data from HSBC. Let's just look at the bottom right-hand chart. And this is really looking at the internet penetration in America of online shopping. So if you like, there's been almost 18 or 10 years of digitalization in internet shopping in the last 18 months. And I don't think people are really going to go back to the old ways they used to shop. And I think we've all got to know the Amazon man or lady pretty well in COVID. I think it's hard to argue against that. I certainly have at home. But some of these trends are just, they've leapfrogged, and they will continue to grow. Not as fast, but they will continue to grow. Amazon's not actually that strong. They're only strong in about 10 or 12 countries around the world. So for like in Italy and various other places, young people don't actually shop so much on the internet compared to UK, which is heavily internet penetrated. So I still think there's a lot of growth going on in this area. HSBC estimate that 50% of all goods will be bought online in the developed markets by 2030, which is really quite a thought. Just briefly on the current interest rate environment. Now, this chart is really trying to show you that just recently in September and October, the front end of global bond yield curves have pushed up very aggressively because the market has essentially sensed that the central banks have got caught a little bit behind the curve. They've had a bit of panic on that the inflation isn't necessarily transitory, or they've lost their resolve that it is transitory. It doesn't really matter. The front ends have come up quite a lot, and the bond market has got a bit of a sniff that interest rates will be rising a little bit in the countries named here. And it's something that as bond managers we're well aware of. And if you like, some of the damage has already been done in the pricing of the bond market. And it's something just to bear in mind going forwards. Now, one of the reasons why central banks may be forced into an interest rate rise is not so much, in our opinion, due to goods or services or commodities inflation, but actually due to tightness of the labour market. And this is most unusual. If I had said to you that we would come out of the recession and unemployment wouldn't have been a problem, you would have looked at me as if I was a Martian. Now, there's some very interesting things going on in labour markets, which frankly currently are quite tight. This chart is showing you the fall in payrolls, people employed in the States, and then the bounce back. But it also shows you that there's an awful lot of job openings in America. So most businesses in America can't find enough workers, which is most unusual. And broadly speaking, there's 5 million less workers than there were pre-COVID, because a lot of people are actually choosing not to go back to the employment market. And I'll expand on that in just a second when we look at the UK. It's important to bear in mind the so-called participation rate. Now, what on earth does that mean? That really means, are people participating in the employment markets, are they looking for a job? Now, as we all get older, the baby boomers wash through society and fertility rates are pretty low, let alone a whole load of people who have retired early because essentially they could afford to because their stock market portfolios had gone up and they've chosen to retire early, and demographic factors and various other factors. Generally, the labour markets will shrink going forwards. There's a bit of a cyclical element in here and a structural element. But as you can see, post the great financial crisis, participation fell and then came back. And into this pandemic crisis, participation numbers have fallen and then come back a bit. But this kind of great reset, the great retirement, the great resignation is very, very topical, because you could argue the unemployment rate on a normal participation number is about 8% in America. You could argue it's about 4.3% because millions of people are choosing not to come back to work. And that obviously means there's less people looking for jobs, which means unemployment is better than anyone could have forecast. And it's a highly, highly topical debate. Just bringing that back to the UK, this is some work from JP Morgan, who estimate that since February 2020, the UK labour force has actually shrunk by 900,000 people, which is broadly speaking why unemployment is so low. In addition, the population is now shrinking, not helped by Brexit and a lot of EU nationals, frankly, going back to Europe and not staying here. The population is shrinking by about 0.5%. It used to grow at about 0.5%. A lot of students are currently so-called inactive, as in they are doing extra studies because they couldn't get a job or they want to do masters and degree courses. And a similar trend to the States. A lot of UK elder people have retired early, and I don't think they will come back to the labour market. Some recent data out of the States that of those people who are choosing not to work, 80% are actually not looking for a job. They don't want a job. There's obviously 20% who do. But a big surprise out of this pandemic is how low unemployment is, obviously helped by furlough and so on. But it's a very unusual situation, and it's something that the policymakers are quite conscious of. The Bank of England have said they're following the UK labour markets very closely and waiting for more data. So, to summarise, higher than expected inflation has caused some central banks, in our opinion, to panic a little bit. They've slightly been kind of stopped out of that transitory narrative. Now, to be generous to them, you could say, well, they're probably more worried about the labour market being tight structurally going forwards. The labour market will come back, but not all today or tomorrow. So that's a kind of ongoing debate. Having said that, in a longer term structural sense, pandemics are actually pretty disinflationary due to that digitalization, the adoption of technology, change in working patterns, grating savers behavior, and so on that I spoke about. But in very much the labour market is kind of the swing factor here. I think the goods market, services market, commodity markets will sort themselves out through time. Give it time. But the labour market is pretty much an important swing factor here regarding the central bank response, who probably will raise rates a little bit, but nothing draconian and nothing dramatic, because otherwise they will kill off demand. And as I said, broadly speaking, once we're through this in the next couple of years, I do think the accelerated digitalization, the way we run our lives, are broadly disinflationary. And longer term, I still think we live in a world of relatively low growth and relatively low bond yields going forwards, accepting that the next few quarters could be quite interesting from a bond manager perspective, and then it could actually get quite interesting again. Really, because I think there is a lack of ongoing sustainable growth in the world. China is slowing down. The so-called fiscal cliff in America is fading, as in they had a massive stimulus last year, but that stimulus isn't going to repeat. And I still think once people normalize, I do believe people are still a little bit precautionary in the way they go about their business. And frankly, I don't think it is the roaring 20s that some of people would have told you a while ago. So I hope you find that's interesting, and I thank you very much for listening.
Next up, the leading lady who holds an MA in Geography from the University of Oxford and is a chartered financial analyst. More impressively, however, she got a half blue at Oxford University for playing in the ladies' golf varsity match. She's admitted, however, it's been downhill for a golf game ever since. She's a busy working mum of 3 children who are all under 7. Now that is impressive. Known for her no messing around attitude at many a meeting, this lady isn't afraid of asking some pretty direct questions. Today, talking about why the UK market is currently offering an attractive long-term solution to those willing to invest in the right areas, plus her sweet shop of opportunities. We'll hear her thoughts on where she expects the drivers of growth to appear in the UK. Ladies and gentlemen, I'm pleased to introduce Rachel Rutter, Senior Fund Manager from J.O. Hambro Capital Management.
Thank you for the introduction. Today I'm going to be talking to you about the fantastic opportunities we're finding in the UK market, a very unloved and underallocated to market at the moment. So there are 5 topics I'm going to talk to you about today. The first one being all about our fund and our team. The second one about why UK now, the UK being very unloved and underallocated to. The third topic's all about the growth opportunities that we're seeing. We're seeing a turn in thematic tailwinds that are really benefiting UK listed businesses. The fourth thing is around sustainability and our approach to it. And fifth, we're going to look at the attractive levels of upside we've got in our fund. So the J.O. Hambro UK Opportunities Fund, I call this the secret sauce. So there are 3 main ingredients to how we invest. The first one being growth, the second one being active, and the third one being absolute. In terms of growth, the first ingredient, we look for businesses that are in areas of the market where there are natural growth tailwinds, and then crucially have those management teams behind them investing in those opportunities. Secondly, we're highly active and we're very, very selective in how we approach investing in the UK. We've only got 32 stocks in the fund. We pride ourselves on doing the work ourselves, and we are highly engaged with the businesses that we own. The third ingredient, and I think of this as the yeast in the bread, the thing that makes it rise, is our absolute mindset. Now, this is all about owning those 30 best stocks in the UK large and mid cap and not caring about what's in the benchmark. For example, we don't like banks and we don't like oil companies, so we have none. We've got a high bar for quality, and that helps with the long-term capital upside, but we think very much about protecting on the downside. For example, we don't like cyclical businesses that have debt. The last piece of this is the valuation control. So we like quality companies that grow, but we're not prepared to pay nosebleed valuations for them. And we've got to have that risk reward in our favour. Here's the team. I've been co-managing the fund for nearly 10 years, alongside Michael Ulrich since 2015. And we've got 2 analysts, Roshni Bolton and Owen Reed. And they bring a wealth of experience. And in fact, between us, we have 53 years of combined experience in UK equities, which is fantastic experience for our investable universe. In terms of performance, the fund's delivered attractive returns of averaging 8% per year since 2005. And as you can see, the fund, we have this very disciplined investment process we like to stick to. And this really comes through in terms of the returns we deliver, both in terms of capital growth, but also helping protect on the downside. And you can see how we did this in 2008, 2018, and 2020. I like to think of the fund a little bit like Emma Raducanu, right at the end of the US Open tennis finals. She fell over, grazed her knee, and had an injury timeout. And when she was sitting there staring straight ahead, someone asked her what she was thinking in a post-match interview. And she said this quote, "I think staying in the moment and focusing on what I had to do and really keeping to my process really helped in those tough times." And meanwhile, Leylah Fernandez, her opponent, was jumping around, picking a fight with the line umpire. And I think this really exemplified to me the importance of having an investment process you can stick to in the tough times and not try to fight the uncontrollable. So on to the second section, UK equities. Well, they're very unloved and underallocated too. You can see from this chart, out of 7 of the last 10 years, the UK all company sector has been the worst selling sector. We're back to 2014 levels of allocations to UK. So where's it all gone? It's gone global. And if I added 2021 to this chart, it's gone parabolic. So flows into global in 2021 have reached $1 trillion already. Now, to put it in perspective, that's 20 times the amount that went into global in the previous, more than the 20 previous years combined. It's an enormous number. And we know the dominance of areas like tech in the global and the US indices and how dangerously overcrowded certain areas are becoming. To put it in perspective, Apple has a market cap of 2.5 billion, and that represents 87% of the entire market capitalization of the FTSE 100. We've got some massive distortions building up. All the evidence points to UK's equities being undervalued, and this chart shows UK average PE of 13 times, and that compares to the MSCI World on 20 times. These charts show the UK being some 30% cheaper than Europe and 44% cheaper than the MSCI World. So we've really got a once-in-a-generation valuation opportunity in front of us. Not everyone's missing it. The eagle eyes of private equity are definitely picking up on the valuation opportunities. And you can see in this chart how the M&A volumes in the UK have really detached from the rest of the world and skyrocketed up to previous peak levels. And barely a week goes by where we haven't got some kind of announcement about a UK household name being taken private. I think there's a misconception about the UK that it's a low-growth market that's dominated by banks and oil companies, which I mentioned we've got none of. And actually, if you break down the FTSE 350 as we've done in this chart, you reveal a much brighter picture for growth. For example, I don't know that many people really know that there are more software companies than banks and more healthcare than insurance companies. But if you're very selective in the UK, you're going to win because the index is going to look very different in 10 years' time. So on to our third section. What are the growth drivers and how are these changing in favour of UK-listed companies? I'm going to talk about three themes. Firstly, investment in real assets, then global digital platforms, and then brands with social purpose. And by the end of it, I hope I'll demonstrate how the growth being delivered is going to force investor perceptions to change. So we've got a massive uptick in spend from governments all around the world in terms of fiscal spend to repair infrastructure assets and really decarbonise our economy. The UK is blessed with many companies that are going to benefit from this trend. Everything from global winning mining businesses like Anglo American, who've got the copper and the cobalt that we need for our hydrogen and battery technologies, through to SSE, which is currently building the world's largest offshore wind farm, all the way through to engineering businesses like IMI, who are making those valves to help stop methane leaks for our hydrogen plants and to make our homes more energy efficient. And just to touch on valuation briefly, a business like IMI, we're forecasting it to grow at least 10% per year for the next 4 years. This is a business that's trading on 15 times earnings. The second theme, global digital platforms. Everyone goes to the US to buy tech growth, but they forget that in the UK, we've got some brilliant tech-led businesses. For example, Next. Not many people know that 90% of the profits of Next come from its online division, which is currently growing faster than Netflix. This is a business that is becoming the go-to platform for UK retailers. Relics. Decades of investment in data and systems. Its risk business has grown at 8% per year for the last 7 years, and it throws off a lot of cash because it's got a 37% margin. And the key message really is, you don't need to take your clients up the risk curve by buying tech startups, because you can get tech-led growth in the UK through well-established businesses that are investing back into those platforms. The third theme is brands with a social purpose. Now, the world's changed. Consumers really want to have a more sustainable future. And luckily, there are many UK businesses that have invested ahead of this trend. To give you an example, Mondi, the paper and packaging company, this business already makes all of those brown Amazon boxes you probably rip open far too often. But they're innovating with their customers to provide plastic-free solutions. I'll give you one example on this slide. You can see this brown paper wrap. Now, this paper wrap has the potential to totally replace plastic wrapping that currently goes around pallets. And just to give you a stat, in Europe alone, 10,000 tons of plastic a year are used in just wrapping up pallets once. And this can entirely replace that. Advertising business WPP is seeing a massive uptick in demand from its customers who want to demonstrate their ESG credentials. And recently it designed a campaign for none other than Google called #IamRemarkable. This became an absolutely global campaign. So all of this growth, how are we capturing it in the fund? Well, you can see here from the stats. The average revenue growth of the companies in the fund is 9.8% over the next 3 years per year. They're very cash generative businesses reinvesting. We've got 32 stocks, and that focus has enabled us to have 111 management interactions over the last 12 months. We've got the high bar of quality, a return on capital employed of 15.7%. And we care about thinking about downside risks. So we've got that low net debt to EBITDA profile of 1 times. In terms of valuation upside, it's good. 7% free cash flow yield, which equates to roughly 15 times price earnings. So you've heard a lot about sustainability from other fund managers, so I'll keep this brief. And what makes us different? Well, firstly, we do the work ourselves. And this is all about that small number of stocks, that very focused approach that we take. We don't have big ESG teams, and we certainly don't outsource the analysis to third-party rating agencies. We want to focus on companies that have the opportunity to change and improve. This is not a portfolio full of wind farms. We want companies that are on a journey and prepared to invest. And thirdly, we have this proprietary ESG scorecard that we use on every company in the fund. And it's based on 3 principles: financial propriety, board and remuneration being appropriate, and social contract. And really what's important is for us is a balance of issues. So we care as much about clean air as we do clean accounting. Not all the companies score top marks, and so that keeps us very busy. We've currently got 24 ongoing engagements out of that 32 stock portfolio. We engage from everything from mining businesses in terms of disclosure. We're talking to consumer goods businesses in terms of how much plastic they use. And for a lot of companies, you can see in this pie chart, we really care about governance and that remuneration packages are properly tied to the long-term strategy and long-term thinking of management. Because ultimately, how someone's paid is how they'll behave. To give you a flavour of a couple of engagements we're having at the moment, Ashtead, well, 1.5 years ago, they had no carbon targets. We worked closely with them. Now they've got science-based targets, and they're investing in new technologies, in hydrogen, in battery-operated equipment. And this is good, not just for them, it's good for their clients who also want a lower carbon footprint. And it drives a bigger wedge between them and their competition because their smaller peers cannot afford to invest in the new equipment. Next, we're appalled by the amount of plastic that comes with an online delivery, and we're engaging with them to really reduce the amount of plastic packaging and ideally use some Mondi boxes. The final topic, valuation. And a lot of rubbish is talked about in our industry about growth and value buckets being these 2 entirely separate things. And I like this Warren Buffett quote so much because it talks about growth and value as being 2 things we have to consider together. They're usually a plus, usually a minus in the value equation. And we like companies that can grow, but we don't want to pay eye-watering prices, particularly when the music stops. So we think about the long-term growth, the quality and the valuation all together to make sure that risk-reward profile is firmly in our favour. This chart just shows that over the last year, the FTSE's gone up. And actually, we've managed to increase the valuation upside in the fund. That's thanks to implementing our valuation control, and also because some of the stocks we own have been very, very out of favour in the market. So the fund's got good valuation upside at the moment. So to wrap things up, people are allocating money away from the UK. This is giving a once-in-a-generation valuation opportunity for us. The big picture thematic drivers of growth are changing, and they're changing in favour of many UK-listed businesses. The J O Hambro UK Opportunities Fund is a very selective fund. We've got good long-term growth, and we've got attractive levels of upside. So we think now is the time you should be exposing your clients to greater proportions of the UK market, and I think they'll thank you for it. Thank you.
Thank you, Rachel. Our next speaker is Tom Slater, co-manager of the Scottish Mortgage Investment Trust. He's a graduate in computer science with mathematics from the University of Edinburgh. Today, Tom will outline how he thinks you can build long-term value by embracing social and structural changes, and he'll tell us the companies that he thinks are set to benefit from them. Ladies and gentlemen, Tom Slater.
Hello. I'm going to talk about what drives Scottish Mortgage and then some of the important investment areas that we think will play out over the next 2 decades or so. I'd start by asking why it's important to be different. Now, of course, superficially, from an investment returns point of view, if you're doing the same as everybody else, then you're unlikely to get a different outcome. But I think it goes deeper than that. The main job of most participants in financial markets is not about providing risk capital to companies or providing long-term returns to savers. Instead, it's the dominant investor mentality is about avoiding downside risk. And for fund managers, the objective is to maintain high margin fee revenue streams for as long as possible, which means staying close to the index and never giving your clients an unpleasant surprise. None of that is about trying to find the world's most exciting growth companies. It's not about investing in business development projects that might or might not work. It's not about searching out the innovative leaders and entrepreneurs of the world's greatest growth companies. And therefore, there's a completely different mindset. For us, it's about thinking about the upside. What might go right at a company, not what might go wrong at a company. Can we come up with new ideas? Not can we pick holes in other people's ideas? And we want to do it for as low a fee as possible. So we're really proud of our ongoing charge. The last year was only 34 basis points. So I think it's centrally important that you are different, but it's also the case that being different aligns very well with the structure of equity market returns. If you look at this slide, you can see on the left-hand side the performance of every investment that Scottish Mortgage has made over the past 10 years. First of all, I draw your attention to the scale. It goes from just about minus 100% to plus 4,000%. And if you look at the individual bars, they follow the 80-20 rule. About 80% of the investments returned somewhere between minus 100 and plus 100%. The ones that made a difference to the outcome, that really drove the long-run returns over the past 10 years, are the ones at the top, the outliers. And it's these companies which have really mattered. It's trying to find those exceptional opportunities and hang on to them for long periods of time. Now, on the right-hand side of the chart, you can see some piece of work that was done by an academic at Arizona State University who looked at 90 years of US stock market data. And in that 90 years to 2019, there was about $47 trillion of excess wealth created. The first 25,500 companies created half of that, and the last 83 created the other half. Its stock market returns are driven by the exceptional impact of a small number of companies. Companies where the market really failed to imagine just how great they would turn out to be. So the first part of our job is looking for companies that have the potential to be one of those outliers. Now, if it was as simple as that, you would get, of course, lots of long-term buy and hold investors looking for the world's greatest growth companies, but you don't. Why? Well, I think the answer lies in the tiny yellow square at the top left-hand side of this chart. It shows the maximum drawdowns for our top 10 performing holdings over the past decade. And they've averaged generally around 50%. Even for our best companies, there have been periods where they're really out of favor. And so that leads me to the idea of hold discipline. Now, sell discipline is something I get asked about a lot. It's a favorite question of the investment consultants. It's always struck me as a bit of an odd concept. The underlying idea, making sure that you test the upside from here for all of your investments, is one that I very much agree with. But the idea that it's somehow indisciplined to continue to own the stocks that you really believe in is something I haven't really understood. Where I do think discipline is important, though, is hanging on to companies. If the impact of that small number of big winners is really to be earned by our shareholders, we've got to be able to endure the difficult times. And so what this chart shows is the returns for two of our biggest winners. So Amazon from 2004 and Tesla from 2013. And if you just look at those charts with nothing annotated on them, then because of the scale, it just looks like bottom left to top right, easy. But of course, the reality is that it has not been easy at all. There have been long periods where these stocks have been really out of favor with the market. And those are the periods indicated in blue. Now, behavioral finance tells us that investors dislike losses about twice as much as they enjoy gains. But of course, for a professional fund manager, it's much more than that. Nobody ever asks me about the stocks that are doing well. So really, what's important is your discipline when you're going through the difficult times. But it's even more than that, because actually those difficult times are often where fundamental competitive advantages are created. If you look at the chart for Amazon, shortly after we bought it in that 2005-2006 period, the shares were really weak. That's because Amazon introduced Prime free shipping. And instantly, all its most profitable customers, the ones who use the service most often, became its least profitable customers because they were getting free shipping. That was bad for short-term earnings. The stock price went down. But I believe that is what has underpinned Amazon's competitive advantage over the subsequent 2 decades. So it's not just that these periods where you have to endure these periods, but actually they may be fundamental to driving long-run competitive advantage for these companies. So what drives Scottish Mortgage is trying to find that small number of exceptional companies, those big winners. And then when we do find them, from a process perspective, how do we hold on to them for long enough? So if that's the framework through which we view the world, for the second part of what I want to talk about is where we see the big opportunities as we look out over the next decade. And I pull out 3 areas. The first is the continued digitization of the economy. The second is the intersection of healthcare with the technologies that have driven that digitization. And then the third piece is decarbonization. So first, digitization. What's been really important if you look over the past decade is the impact of a small number of technologies or technological improvements. So Moore's law is the one shown on the chart. The computing power you can buy for $1 doubles every 18 months. That's not really interesting in the short run. What's interesting about it is if you look out 10 years, because it implies computers are 100 times more powerful. And so what are the opportunities that unlocks? But Moore's law is just one example. So you can look at the cost of generating energy from solar, the cost of storing energy in a battery, the cost of sequencing a base pair of DNA, the cost of training a machine learning algorithm. There's all of these trends that are really quite predictable. And actually that's quite rare in investment. There are lots of things that people try to predict that are completely unpredictable. What will GDP be next year? What will interest rates be? But actually driving some of these changes are these really fundamental trends. And so if you think about that in media, in retail, it's driven a revolution over the past 10 years. And we think that absolutely continues. There are interesting companies, ByteDance, using using machine learning to really change that space around online socialization and entertainment. But we see the spread of this technology into lots of areas of the economy that have just not seen that pace of progress in the past. So food would be a great example. Who would thought the food industry would be digitized? But actually what we've seen is that it's an area where there are huge inefficiencies. The current model of going to supermarkets, bringing all the food home, unpacking it, getting out to cook is really inefficient. So this started with platforms for ordering online, but then we've seen quite quickly as you've done that you can bring in delivery. And once you have your own delivery, you can expand selection, which access to the restaurants that weren't previously available at home. And you can drive down price because you have a bigger network. You can increase convenience because you can deliver things more quickly. And this category of companies is rapidly expanding from prepared food into grocery, into dairy, into alcohol. And it's a whole new way of and much more efficient, less carbon intensive way of consuming food. We see that in enterprise software, where we've historically hosted all our own software in data centers and offices, but gradually we've moved to the cloud because it's safer, it's more economical. What we're now seeing is a generation of companies that are cloud native, that are doing things you just couldn't do with on-premise IT, deploying sophisticated machine learning against all of the huge data sets you're collecting. And finally, we're seeing it in finance, particularly in payments. Payments was a boring area because there was only so much of a transaction value of a transaction you could capture by providing the payment. But what we're seeing with some of these new companies coming through is that data is crossing the transaction. They're bringing new customers to merchants. They are increasing the conversion for those merchants of those new customers. They are increasing the spend of those customers. And that companies like Affirm are really driving huge value, and that's coming from the marketing budget of their customers, not from the transaction budget. So we see the digitalization is spreading to lots of new areas. None probably is more important than healthcare. And in healthcare, you've seen huge cost inflation over the past 30 years, now approaching 20% of US GDP. But what if that were to change? Moderna is a company that we've become familiar with through COVID and the production of their COVID vaccine. But what's more interesting to us is the mechanism by which that vaccine was created. It's software. It's manipulating cells to produce therapies for patients. But you do that by programming the cell, not with zeros and ones, but with G, T's, A's, and C's, genomic code. But it has all the same characteristics of software as we know it. You can do this at scale with zero or very low marginal cost. You can operate much more quickly than we've got used to in healthcare. You can grow faster as you get bigger, as you scale the code base that you have. And that creates all sorts of opportunities, and it's also very deflationary. We see the same thing in the application of AI to drug discovery, where you used to be limited by what a PhD student could do at a lab bench. But today, supercomputers are doing all of that work at massive scale. So I think there's some really interesting opportunities around where AI meets tech and technology meet healthcare. And then the third theme is around decarbonization. This is really interesting because so much infrastructure needs to be invested in. If we are going to phase out internal combustion engines in passenger cars in the UK by 2030, or if Norway's going to do it by 2025, there has to be a huge investment in the supply of batteries. There has to be the returns involved to generate that type of investment. Companies like Northvolt are doing that. Redwood Materials, recycling those batteries at end of life. That should help to drive down costs and further improve decarbonization. And then there's a whole set of companies that are using this infrastructure to provide services. We sort of have a concept of the idea of electrification of passenger vehicles, but that's going to happen in delivery vehicles, it's going to happen in aircraft, and we can see the companies coming through that are doing that today. So those would be the three big areas that I would pick out. The continued digitalization of the economy, the intersection of healthcare and technology, and then the investment that goes around decarbonization. And so if we look out, if you're going to find the winners for the next decade, I think you have to think about the world differently. You have to think about the impact of a small number of exceptional companies. You have to orientate yourself around finding those individuals and providing them long-term funding for projects that are risky and have uncertain payoffs. And at Scottish Mortgage, that's what we're trying to do for our shareholders with a very long-term mindset.
Our penultimate speaker of the day is an industry veteran and someone I'm looking forward to hearing speak. With 30 years industry knowledge, I think this guy knows a thing or two about investing. Not only is he known as Britain's best-known bond investor, according to the Daily Telegraph, he's also a lifelong Nottingham Forest and Smiths fan. He collects football memorabilia, having recently completed a 1979 Panini football sticker album that he found in his dad's loft, courtesy of the Ron Atkinson sticker he found on eBay. Talking today about inflation and his key concerns, and a look at what the potential impact of those could have on growth. Jim Leavis, Chief Investment Officer of M&G Investments, will address the economic impact following the end of enhanced unemployment benefits in the US and the end of furlough here in the UK. Here he is, Jim Leavis.
Thanks, Danny. Hi, I'm Jim Levis. I'm here today to talk about global bond investing. And as it's that time of year, I'm sure that millions of different notes will be coming out, your outlooks for 2022. And if they're anything like the notes that I get on my desk every day for the last few weeks, and even going back to January's year after year after year for decades now, they all say at this time of year that we're in a bond bubble and that bond bubble is about to burst. And as you know by now, every year those predictions are wrong and bonds have continued to be really important parts of your portfolio. So what I'm going to do today is show you that this isn't just a modern thing that's been going on recently. This is something that goes back around about 700 years. I don't expect you to look in detail at this chart, but you'll see that people like Simon Van Halen, probably not related to Eddie Van Halen, but made a loan to Edward III and the interest rate he charged was 35%. Go forward a few centuries, it goes down to 16%. By the time you get to a Rothschild's loan, it's down at 6%. And you see that the trend of history is for lower and lower government bond yields, whatever period of time you look at. This is a big long-term trend. And we have to ask ourselves as bond investors, why on earth does this trend exist? And I think it's pretty easy to explain. We're living longer, so demographics are much more in our favour. As we live longer, we need income. We need security in our retirements. And you'll know this from all of your clients. They want stable, safe, secure income streams. So as we live longer, and a peasant in the kind of Baldric Middle Ages might have lived until 32 or something like that, nowadays your clients may well live to be 100 or longer, and they need secure income. And that demand in Western economies for income has produced this big downward trend in bond yields. The second big trend, of course, is technology, and we all know this. Whenever we shop on Amazon, we know that things are cheaper than when we were growing up because we've got a lot more choice. We can buy our stuff from anywhere in the world. We can at one click see where the cheapest item is in the world. And that's not just us, but that's people buying stuff for companies, whether that's steel or energy. We can find the cheapest things in the world. And also technology has delivered innovations like Uber. And some of these are negative innovations in some way, driven down wages as well as prices for people involved in the gig economy, when they can use their phones to kind of just get an hour's work here or there, but maybe at lower wages. So technology's impacting us in loads and loads of ways, but one of the most important ways is it's driven down inflation, and that's allowed interest rates and bond yields to stay low. Finally, the big theme you can see on this chart has been one of globalization. You go back to the beginning of this chart, it was all about Europe. Probably you wouldn't have left your nearby village, let alone got on a plane and travelled to Tokyo, as we can do today. And the same is true of goods and services now. We live in a globalised world. That's not just true of the fact that we can get goods from China very, very cheaply now because they're manufactured there, and that produces lower prices and lower interest rates. But it's also the global nature of saving. So the Chinese government buys lots of US Treasury bonds. That drives down the bond yield. And it's also globalisation of labour markets. All our wages nowadays are potentially kept stable or lower than they would have been otherwise, by the threat that somebody from a developing market could take our job now, because the technology allows them to do that. It used to just be about workers being able to, BMW may be moving a car factory to another country. Now all of our jobs could go anywhere in the world. So these mega trends in bond yields have kept bond yields very, very low. And I think you don't fight those three big trends. I think if you look even more recently to the last 30 years, those trends continue. We know that China joined the World Trade Organization at the start of the millennium, and that's opened up a world of even lower prices than before. And you see there, we then had the global financial crisis, we had the Eurozone debt crisis, and most recently, of course, the horrible coronavirus crisis that have driven bond yields down and down. The other big thing that's happening over this period, of course, is independent central banks. I think we must be a bit careful about that. They take a lot of credit for fighting low and keeping inflation low, but I think their powers are probably overstated. But nevertheless, at the moment, there are some very big debates going on about the independence of central banks. Maybe they want to generate some of this inflation that's sweeping the world at the moment. Maybe they're happy with that because it allows government debts to be inflated away, and that's all good. I've got 4 pictures up on the screen here. You can see there Jay Powell. There's some doubt about whether he will be kept on by Joe Biden as the chair of the Federal Reserve. Maybe he'll choose the person on the top right instead, who's called Brainard, and she is regarded as much more dovish. And so perhaps Joe Biden wants to keep the US economy running hot, even if that means lots and lots more inflation. I don't think he does really want that, because a lot of Americans are feeling the pain right now, the pain of higher inflation. But nevertheless, it's a hot topic. How independent are central banks going to be from now on in? And at the bottom here, I've just got Bailey and Lagarde, heads of the Bank of England and the European Central Bank, respectively. And they've come into a bit of criticism recently about how they're handling their communications about whether interest rates are going up or not. I think Bailey will hike interest rates before the end of 2021 in the UK, especially given the most recent inflation number and the really spectacularly good jobs numbers as well, even though we saw the end of furlough. We'll go into that in more detail another time, but nevertheless, it's something to bear in mind. So when I think about bond markets and whether there's value and whether I should believe in those broker notes saying this is the end, the bubble is about to burst, I kind of like to look at this chart. Again, not in any great detail for today, but this is showing where the market thinks very, very long-term US Treasury bond yields are going to be. That's the green line here. And then the band that I've got here is really where the Federal Reserve's economists think that long-term interest rates are going to be. And I just use this as a really simple measure of whether there's any value in US Treasury bonds or not. And quite helpfully, this has enabled me to buy bonds when they're cheap and sell bonds when they're expensive. When bond yields in green go below the lowest expectation of a Fed member, then it's probably time to say, well, they're looking expensive now. When they go above the top of that band, it's probably time to say they're cheap and I should buy them. Unfortunately for us as bond investors right now, you can see it's right bang in the middle of that range. But I do think that that's showing you that bonds are probably around about fair value now, having seen a big sell-off over the course of the summer and into the final quarter of 2021. We're now somewhere at fair value. So it makes you a bit skeptical when you hear people say that this sell-off in bonds goes on forever. We've already had a sell-off and there's a bit of value in merging back in government bonds. But the real value in bond markets probably isn't in developed market bonds at all. The red bars you see here are developed markets. These are inflation-adjusted yields. You can see there that when you take a bund yield or a treasury yield or a gilt yield and you take off inflation from it, you get a sharply negative return. And that makes it quite unattractive to us and probably you and your investors and clients too. So you can see there negative real yields, inflation-adjusted yields in developed markets. The green bars, though, tell a completely different story. Emerging markets have had a torrid time. There's been lots of geopolitical uncertainty, whether that's China and potential of conflict with Taiwan, or Evergrande, the property company, getting into difficulty. You've seen coronavirus hit them hard as well. And you've seen Russia, sanctions there, rumours of war with Ukraine coming soon. There will always be bad headlines about emerging markets, but you can see here that you do actually get paid for that. So the real yields you can achieve in emerging market bonds at the moment are more like 2 or 3%, in some cases even above 6%, compared to those negative yields you saw for developed markets. Not a lot of value in credit left though. These are credit spreads. You can see in the middle of last year, in the depths of the coronavirus lockdowns in May and June, when we really didn't know what was going to happen, how long this would last, credit spreads leapt out. You see here for high yield, the spreads were incredibly high, 2,000 basis point spreads briefly. That's going back to the great global financial crisis. Last time round for coronavirus, we got to 1,000 basis points over. So everything distressed effectively in high yield, and a big leap in investment grade bond spreads as well. And this was a great buying opportunity. We, and I'm sure many others, bought a lot of corporate bonds at that time. But you can see here that valuation opportunity has probably dissipated now. Credit spreads are back down to where they were before the coronavirus crisis started. I don't think defaults are going to increase dramatically anytime soon, but certainly you're not getting paid. We're priced to perfection. Nothing can go wrong for corporate bonds from here to justify the level of spreads that we've got in the market. And as a result of that, while we still do own some credit in our portfolio, we have been reducing corporate bond exposure and high yield bond exposure over the course of the end of last year and throughout 2021. I'm going to finish very quickly with a quick look at currencies. Currencies are more volatile than ordinary bond markets, but they can give you some really interesting valuation opportunities. We think you can value a currency just like you can value a bond. And that's exactly what we've done here. This is what we call the currency snail. It's a chart that ranks the currencies around the world by a number of different measures. You've probably heard of the Big Mac Index that The Economist magazine does. That's really comparing comparative inflation rates in different countries. And there are a number of other ways you can look at relative valuations between the US dollar and the yen, emerging market currencies, and sterling. So on this chart, think of it like a clock face. At midnight, you've got the cheapest currency in the world on 3 different measures of currency valuation. As you move round to 3 o'clock and 6 o'clock, the currencies become more expensive. And it's just worth pointing out that we like to sell and get underweight those currencies that are the most expensive and buy those that look cheap. And at the moment, we've seen a big rally in the US dollar, and you'll see that around about 11 o'clock, getting on back towards the most expensive currencies, which are the Swiss franc and the Filipino peso. Down at the cheap end, though, you've got the Japanese yen, which historically has been quite a good diversifier when things go wrong in the global economy. So you can buy it cheaply now, and it will diversify your portfolio against risks potentially. And you can see as we go around, the euro is probably fairly valued. It's somewhere down the middle there. And where are we with sterling? Around about 7 o'clock. So again, not far off fair value. But probably the US dollar has got expensive now, and we'll be wanting to reduce our dollar exposure and start looking at some of those cheaper currencies, many of which you'll see are emerging markets in their nature. So to conclude then, next year, it's possible inflation is not transient. It's possible that we end up with central banks hiking interest rates from here, but that's already in the market. The market is pricing in 6 rate hikes from the Fed. It's pricing in 1% interest rates from the Bank of England. And as I say, I think government bond yields now are looking almost like fair value. So I'm underweight duration still, but I don't think the bond bear market necessarily has got a million miles more to go before it's time to start adding. But credit's looking expensive. On the other hand, emerging markets looking decent value at the moment. Have a great rest of the year and a fantastic 2022.
We've almost made it, and I guarantee our last 15-minute session will fly. If you've never heard him present before, you're in for a treat. AJ Bell's investment director, Kevin Doran, certainly knows how to put on a show. A top-rated speaker at Investival and a firm favourite when out on the road, he's never far away from a costume or a theme. So, since our last Investival, and over lockdown, instead of buying a Peloton bike, like so many others, he bought a gym, a whole gym, and not just a gym, but he launched the UK's first sponsored women's powerlifting team, the Good Lift Girls. You should check them out, they are pretty impressive. Talking today about the ever controversial asset class cryptocurrency, Kevin will take us on a tour of the crypto landscape, arming you with information to take on those probing clients' questions and helping to keep your client's portfolio on the straight and narrow. Ladies and gentlemen, hold on to your hats. Here's Kevin Doran.
Okay, thanks for that, Danny. Wonderful introduction there. Thanks so much. Cryptocurrencies, the thing that everyone's talking about, but no one can buy. Well, in the next 20 minutes or so, we'll give you a brief introduction to cryptocurrencies, everything you need to turn up at a client's house, particularly if they brought their grandson along, and talk cognitively about cryptocurrencies, all in the next 15 minutes. No conversation can start about cryptocurrency without this guy, Satoshi Nakamoto. So Satoshi Nakamoto, this isn't Satoshi Nakamoto, by the way. However, it's the only person in the world who's called Satoshi Nakamoto. Satoshi Nakamoto is a fictional character. He is the name, however, that was put on the scientific paper released in January 2009, which introduced the world to the land of cryptocurrencies, a world where currencies had no central bank, no central government, and currencies were created not through governments and interest rates, but through the process of cryptographic algorithms. And Satoshi Nakamoto, whoever he, she, or they are, that's the person who invented the cryptographic algorithm. Now, when we talked about cryptocurrencies, most people say to me, Kevin, stop. It's way too complicated. I don't understand this stuff. The shutters go up and no one wants to talk about it. It's too complicated. It's all a bit too nebulous. It's all a little bit too 21st century. However, every single person watching this video believes in something which is way, way, way more miraculous than cryptocurrencies. In fact, it's the world's largest religion with over 8 billion individual believers. If you added up all the religions on the planet, added all the believers together, it comes to about 5.5 billion people. So nearly another 3 billion people believe in this one act of faith. And what is that act of faith? It's money. The greatest con trick ever pulled off by humanity. Not Kaiser Soze, not the hustle. The greatest con trick ever pulled off by humanity is that of money. It's a social construct. It's a social construct to solve a problem that existed way back in time when we lived in a barter economy. And what you have in a barter economy is, let's suppose, for example, you're sat there at home and you've got a wonderful jumper on and you'd love to have this tie in Bitcoin orange. We need to have two things in order for that exchange to take place. I need to have something that you want. You need to have something I want. And we both need to want the equal and opposite thing at exactly the same time. It's what economists call a mutual coincidence of wants. And money was invented to solve the problem of mutual coincidence by creating a distortion between the point at which you want to buy something and the point at which you want to sell something. And that's what money does. Money acts as a middleman between those transactions, a store of value so that you can take apart that barter economy and separate it into purchases and sales. And once you've done that, you've revolutionized the entire economy. We've now got a quantum leap in economics, and money has taken throughout the history of time a whole different raft of forms, ranging from tulip bulbs, gold and silver coins, bits of stone, until the present day where you have paper money backed by central banks and issued by governments. Now, the cryptocurrency believers, people like this guy, for example, the cryptocurrency believers believe that that world is finished. The cryptocurrency believers think that this world, particularly post the Nixon shock in 1971, have created an environment where money can be created at will by governments in order to affect their own needs and control societies. Now, you don't need to be a conspiracy theorist in order to believe in Bitcoin.
Wouldn't it be wonderful if there were a world where everyone had a single currency? When you're transacting across borders or when you simply go on your holiday, wouldn't it be great if you have a world where there were no frictional transaction costs as you transition from one currency into another currency? Bitcoin solves that problem. Another use case, and probably the best use case, is the transmission of money across borders, particularly between the developed world and the emerging markets. And that's why you may have heard, for example, that most recently in Bolivia, they now accept Bitcoin as legal tender. Why would that be the case? Well, the Bolivians in the 1990s went through a significant economic downturn, which meant that a lot of young Bolivians went to live in different countries and send those remittances back home to their parents and their grandparents. Now, at this moment in time, if you do that through Western Union, PayPal, etc., those remittances come back home with a frictional cost of maybe 1, 2, or even 3 or 4%. So by allowing Bitcoin to be legal currency within the environs, what you're allowed to do there is send that money home, and that takes place almost frictionless. So less than 15 cents in order to send that money home. So you don't need to be a conspiracy theorist, but trust me, if you are a conspiracy theorist, you're already bought into Bitcoin. What we'll do next is we'll take a look at the current monetary system, and we'll see how that builds up and how it builds up over time. And then we'll make the analogy of how Bitcoin works, and you'll see how actually money and Bitcoin, and all cryptocurrencies for that matter, all follow the same kind of format. Now, let's suppose there are two people in an economy who want to do a transaction. Yes, they could transact that money in a cash transaction, and that wouldn't be seen by any of society or the banking system. But most transactions these days don't take place in the form of cash. They take place through the banking system. So let's delve into the banking system a little bit deeper. When that transaction takes place, nothing physically happens. All that happens is the ledger held by all of the banks, we all agree what that ledger is. It's a golden record of every single transaction that's ever taken place in that currency. And as a consequence of knowing every transaction that's ever taken place, you have a list of all the balances that everyone owns in that currency. So when you effect that transaction, two numbers change on the agreed ledger. The banks all agree that, and that's how that transaction takes place. It's how it's settled among society. But of course, wouldn't it be nice if you could break into the banking system, mess with that ledger, and affect a transaction that made your bank balance go up, not even at the expense of someone else? So it has to be a trusted ledger, has to have social conformity around it, and everyone needs to trust this ledger. And that's why we only allow access to that ledger through a licensed banking system. But the question then arises, what happens if some of the banks within the system can't be trusted themselves? So in order to buttress this system, what we do on top of that is we put a central bank in place. And if the central bank can't be trusted, let's go the whole hog and put a British flag on top of it, or any national flag for that matter. And now what you've got is a central bank backed by the entire government, overseeing all of the licensed banks within society. Those licensed banks are the holders of that agreed central ledger, and it's that central ledger which allows transactions to take place within society. So bear that in mind, look at the component parts of that, and now let's go to the world of Bitcoin. What you've got in the world of Bitcoin is an agreed but not centralized ledger, a decentralized ledger. Everyone has the same list of transactions that have ever taken place in Bitcoin in this case. Everyone agrees that they are the transactions that have ever taken place in Bitcoin, and as a consequence, everybody knows what everyone's balance is in the form of Bitcoins. Your access point to this system is not a bank in this place, it's a computer. And in the early days of Bitcoin, it literally was a desktop computer that would sit on your laptop or your desktop. Now, we'll talk about what that system looks like a little bit later on, but that's essentially what it is. It's a computer, which is your access point to the agreed ledger, which is known in Bitcoin world as a blockchain. And then you put all of that around the safety and security that comes with Satoshi Nakamoto's cryptographic algorithm. You have exactly the same system in place for Bitcoin and cryptocurrencies as you have in the monetary system that we all know, love, and transact with on a day-to-day basis. So what is that cryptographic algorithm? Now, I'm not going to go into the details of how that works today, but it's not a simple algorithm. There's a 1 in 13 trillion chance that you could possibly guess the right result. It's the equivalent of me giving you a plate of mince and I ask you to tell me the name of the cow and put the cow back together again. That's the likelihood of getting the right answer when you're trying to solve the cryptographic algorithm. It's a process of trial and error. It's monkeys typing out Shakespeare. Yes, it can be done, but it'll take an awful lot of iterations in order to do that. And that's why today it's not laptops and desktops which are solving that problem. It's supercomputers in Bitcoin mining factories. Because when you solve that problem, your reward for solving the cryptographic algorithm is you are rewarded currently 4 Bitcoins for every single time that you solve a problem. And that problem is solved every 10 minutes. So every single 10 minutes, monkeys are typing out the entire works of Shakespeare. All that happens there is every single transaction that's taken place in Bitcoin in the previous 10 minutes gets etched into a block. The cryptographic algorithm solves the problem. All of the computers on the network agree that that is the right answer. And then that block gets added to the golden record of every single transaction that's ever taken place in Bitcoin. And now you've got an economy that works just like the economy that we know in the monetary world. You have people who own Bitcoins and their Bitcoin wallets. They've got access to the Bitcoin cryptographic currency system. Your agreed ledger is your blockchain, and your access point to that are the supercomputers, all secured under the trust of Satoshi Nakamoto. Money is what money does. Money can be absolutely anything. And here we look at kind of the 3 main things which are believed to be money in modern day. So that looks at the dollar, it looks at gold, and it looks at Bitcoin. And what you'll see is in Bitcoin, on the first 5 features that you would want from money, Bitcoin wipes the floor with all of the forms of currency. However, at this moment in time, Bitcoin is not acceptable in most places. You couldn't walk down to your fish and chip shop, well, certainly most fish and chip shops, and buy your fish and chips in the form of Bitcoin. And more importantly, at this moment in time, Bitcoin cannot remotely be considered to be a store of value. And it has to be a store of value to be considered money. In the last 12 months alone, Bitcoin has traded as low as $16,000, as high as $69,000. And as I'm sitting here right now, although God knows what it will be when you're watching this video, it's currently trading at $59,000. It is not a store of value. And that's why currently Bitcoin is not a currency. You should think of it as a crypto commodity. And other crypto commodities are available. Now, whilst we're on the subject of commodities, let's go to the last time there was a major upheaval within the world of money. That's 1971. We go back to the Richard Nixon gold shock. In 1971, Richard Nixon took the US off the gold standard. Now, if you know your history of money, you know that most currencies adopted the gold standard until the Bretton Woods Agreement. At that point, the Bretton Woods Agreement, all currencies were convertible into the dollar, and dollar was convertible into gold. That was until Richard Nixon stood up in 1971 and took the US off the gold standard. From that day forth, all monies across all of the world have followed something called a fiat monetary system, which means you can literally create money out of thin air. Now, the consequence of the fiat monetary system in 1971 is it created a significant demand for gold because gold was seen as a higher form of money. And you'll see on the chart that as a consequence of the 1970s, the price of gold spiked significantly. Now, lots of people as a consequence now view gold as the ultimate hedge against inflation. But actually, if gold had followed the path of inflation since 1980, you'll see that yes, over the subsequent 42 years, right now, gold is adjusted for inflation, exactly the same price it was in 1980, therefore is a viable gold inflation hedge. But for most of the last 42 years, in fact 95% of the last 42 years, gold has traded below the rate of inflation. Gold is not an inflation hedge. What you should view gold, and if you are holding gold within your portfolios, it's a put option on central banks. And what's the correct price of gold? Well, currently, the actual price in the marketplace is around $1,800 per ounce. But gold is a commodity. The gold brought out of the ground in South Africa, right here, right now, as you're watching this video, the cost of that gold is not $1,800 an ounce. It's currently just over $1,000 an ounce, but that ounce of gold is exactly fungible with every other ounce of gold that's ever been mined in the history of mankind. It is a commoditized asset, and so any ounce of gold is equal to any other ounce of gold. And so if you can produce gold at just over $1,000 per ounce, and the current price is $1,800 an ounce, what do you think the natural real-world consequence of that is? You're right. Lots of gold is currently being produced by gold miners, particularly in the likes of South Africa. And it's being produced at around $1,000 per ounce, which means that, yes, it will push up the input price of trying to create gold, but the increased supply of gold will act as a weight, a dead weight on the price of gold. And so the center of gravity for gold is more like $1,000, $1,050 per ounce. So if you are holding gold in your portfolios, fantastic. If you held it in the last 42 years, it's been an inflation hedge. But if you are holding gold in your portfolio right now, the right price for gold is about 40% lower than we are today. Which brings us to Bitcoin. That's the current price of Bitcoin. Like I say, when we put these slides together, it was just over $60,000 per coin. Right now, it's $59,000. Who knows what it will be when you're watching this video? But let's apply the same principles. What's the marginal cost of production for a Bitcoin? Now, in order to understand how Bitcoins are produced, you need to understand how Bitcoin mining works these days. Bitcoin mines, like I say, in the old days, it was your laptop or your desktop. You could legitimately mine from home Bitcoins. That's not how the world works today. There are so many people on the network, and of course, the first people to guess the right answer are awarded with the Bitcoin. And so now there is an entire industry of people. This is a Bitcoin mining facility on screen at the moment. There's an entire industry of people who are trying to mine Bitcoins. Now, what you see in front of you is an array of supercomputers with super fast, specific chips within them. It's basically a massive Xbox. That's the best way to think about it. And those lines that are coming off those supercomputers all lead to the power supply grid. Bitcoin is interchangeable electricity. The single biggest cost of producing a single new Bitcoin is the cost of electricity. And so if you want to understand the marginal cost of producing a Bitcoin, you need to understand the electricity involved in order to achieve that. Now, the two biggest countries in which Bitcoins are mined are China and the United States. So let's take the average of the two of those and split the difference. The marginal cost of producing a single Bitcoin right now is currently around $4,000. The price of Bitcoin is around $60,000. Bitcoin is over 90% overvalued. And so the young people of the day who are all trading cryptocurrencies and having the whale of the time, the analogy is the Klondike. So the young people of today who are mining these Bitcoins, playing with the Bitcoins, investing in these Bitcoins, it's the equivalent of the Klondike. Don't deny them their fun. They're having an absolute great time. They're learning about investment. They'll learn some hard lessons along the way, but they're having a great time hanging out with their friends and doing things which are far less nefarious than they could possibly be doing. But the people who made money out of the gold rush and the Klondike were not the people who turned up in the mines and got their hands dirty. The people who made the money in the Klondike were the providers of picks, shovels, pans, and sieves. And those people exist in the marketplace today. They exist in your existing portfolio. And so when you're asked by your clients, what's my cryptocurrency strategy? You've already got all of these positions within your portfolio.
Thank you, Kevin. Well, that concludes the talks for today. A feedback link will pop up immediately after this webinar closes, so please do complete that, and we'll soon be sending you a copy of the slides and your CPD certificate. Thank you again for your continued support, and please enjoy the rest of your day. We look forward to seeing you again soon.